Bring Okay, Alex, I'm going to make you co-host. If you wouldn't mind just helping me if people are coming in the room, just to let people in, please.
Sure, will do.
Okay, welcome everyone. I want to make sure that Alexander, my co-host, yeah, so you co-host there. Welcome. I want to make sure that we get started on time. So I know there's a bunch of people that are still joining us, but I want to get going. So welcome again to the Mastermind for August of 2023. We've got an exciting session today. However, before we get started with Anthony and his update, which I'm really looking forward to, I want to pass out some congratulations. So there's a number of people that are part of the Mastermind that have actually been through and done the Wealth Going Global course and actually got all the way to the end and built out not only their wealth plan, because you can now do it digitally, and their investor strategy sheet. So we've got some celebrations to have and some certificates to pass out. So the first one is to Victor. So just well, congratulations, Victor, on going through the whole process. The next one is to Abdul. So I'll make sure that we send you these certificates. The next one is to Steve Kelsey as well, to Diana, and to Dr. Mari. So well done to all of you. Congratulations. If there are others, let us know. We did actually check whether people had finished and got their certificates. And for those of you who haven't done it, it is there as a resource to give you a lot of foundational knowledge. I also wanted to just share with you that I've spoken with a number of people that have been talking about the whole value of generational wealth and passing it on with their children, etc. So what I would appreciate is if you could just send me a WhatsApp, if you're watching the recording, or even if you just want to put in the chat box. And all I want you to do is, if you just want to share me, just send a message, just say family or family deal, if you're interested, because what we're looking at doing is putting together a package, because it's been a pattern that's coming up over and over again, where ideally we want to help people. So people have said, hey, we want our children to do this, etc. So we want to create, we're looking at creating a family solution so that, you know, the children can do Wealth Going Global and actually have access to asset mastery, etc. So if it is something you're interested in, just type in there, just send me a message, family, whatever, and we can talk more about it in terms of that process. It's really something we hadn't thought of it. It's something we're just putting together based on a number of people wanting to do that. And then lastly, I wanted to celebrate a little bit with Cynthia, and equally for yourself, Anthony from Calio. Cynthia said that I could share this. She literally sent this to me yesterday. You know, so she's living in Italy. Her children are going to university in Bath, and her daughter's, you know, just about to go there. And she said, Calio has helped me invest in a 3-year promissory note that's generating monthly dividends that allowed me to say, fine, despite the fact that the uni tradition. So that's a discussion she's having with her ex-husband. The ability to do this was so liberating, not just to make ends meet, but to have unexpected huge hit that doesn't derail me financially. It is the first time that's happened to me in 10 years. Thank God for this mastermind, the partners it brings us, and the exponential learning you gifted us. So I just wanted to celebrate you, Cynthia, because I think all of these wins not only are wonderful for the individual, but they're also wonderful for us as a collective whole, because it sort of reminds us of all what we're doing. And then just to remind everyone of the sequence, I am going to talk about it later, but we always start with Anthony and the market update. Then we're going to be moving to Gary and the main theme for the month. I will then update you with any sort of admin or details that we need to know. And then we'll do a check-in with each member, remembering that step 4, execution, accountability, and mindset are critically important. I'm also going to talk a little bit to this now. I just want to give you an update on it. I do welcome people to do the hot seats, where from a coaching perspective, I can help you get results and get individual feedback, and, you know, actually one-to-one, it's available for people. And then ultimately we close out and reminding everyone of the Google Sheet. So just before we hand to Anthony, reminding everyone that our goal here is globally diversified passive income. and diversifying across countries, currencies, assets, partners, and time. And I'm going to share this picture on the WhatsApp group. But what we've done is we've simplified it. So everyone should have done their one-to-one with me. And then once you've done your one-to-one, you fill in the Google Sheet. So we're trying to make it really easy for people in terms of the link. Then, we introduce you to Callio. There's a number of you that haven't met with Callio yet. So we need to make sure that that happens. Analyzing the current portfolio and Alex to assist with that process. Then the next step is ensuring that the wealth plan is put together and finalized. And that's part of the whole setup. What's really important, though, is step 4. And so I'm noticing that a number of people, can't necessarily make the live session now when we're learning and they're watching the recording because of time zones or whatever. So I'm going to make myself available every month on the same day at 8 a.m. South African time, 8 p.m. South African time, and for an hour after the master session. So there'll actually be 3 hours in this day to make sure that we're working on step 4. So that's all about, we'll talk about it after Anthony and Gary, but it's really, really important that we are making sure that we are using the accountability, the mindset, the coaching, and the execution to get results. So I'm just, we've spoken a lot about this, Alex, Shane, and myself, and making sure that there's more time available to people to make sure that we're checking in and we're getting monthly results. And then finally, we've got today's session and, ultimately what we're doing. So without further ado, I just remind you that step 5 is all about the market and currency analysis, the portfolio construction, which is what we're doing with Anthony. And then we're moving to the financial understanding, which is what we're doing with Gary. Without further ado, I want to hand to you, Anthony. As always, I look forward to finding out what's going in the global market. Sorry for a little bit of a long intro, but I wanted to celebrate with people that have achieved milestones in the last month. And welcome to the new members as well. It's wonderful to have you guys, and I look forward to you enjoying your first session.
Thanks, Scott. Morning, guys. Before I start, firstly, just Cynthia, that's absolutely great news. I'm glad we could be involved in that and help you out there. That's really nice to see feedback like that. So thank you.
And please, and I think, Anthony, I echo you, but any wins like that, it's wonderful to hear it. So Cynthia, I really appreciate you sharing it. It's always good to hear people making progress and winning. It's wonderful.
Yeah, agreed. Alrighty, I'm going to share my screen quick. We can get stuck in. Can you guys see that? Is that all good?
Yes. If you just want to put it into
Cool.
PowerPoint mode, it's into slide mode.
Yeah, sure. There we go. All right, in my usual fashion, I'll just start with the indices, just so we can get a kind of bit of perspective and understand what happened throughout the month of July. Again, another strong month for developed markets as well as emerging markets. We can see here the kind of key driver this month was certainly China. In the bottom right there, they came back online quite nicely, up 7.6%. The US, again, just off to the races. Been an exceptional year for the US so far. S&P up 3.2%, NASDAQ up 3.8%. The DAX, which is Germany, slightly behind at 1.9%. The UK up 2.3%. I was asked to add the ASX, the Australian Stock Exchange, the ASX 200. They're up 2.9%. Russell 1000 up 3.4%. I'll talk to the dispersion in the returns and the other sectors of the US economy coming online in a second. Just for context, again, this is in base currency for the respective index. Moving on, I revert everything back to US dollars. A lot of people like to get their kind of benchmark understanding in USD. Just makes things a bit easier for them. And you can see there again, a fairly similar story. The USD did depreciate a bit throughout July, but not much. On a year-to-date basis, again, in base currency, you can really see there in the red line the strength of the NASDAQ up close to 45% as at the end of July. Again, on a year-to-date basis, S&P 500 up 20%. Very, very, very strong numbers out of the US. Just talking to what I spoke to last month around the key drivers of that S&P 500 being your large cap tech, and really been a story this year of last year's losers or this year's winners. So nice to see some of that big tech coming back strongly. Again, we saw a bit of a shift throughout the month, which I'll talk to, but still the overall US economy looking quite strong at the moment. Indices in USD. Again, we can see China, although they had a really good July, they still largely flat for the year and are lagging other developed markets and EMs quite a bit. DAX also doing well. They had a very tough year last year, and FTSE kind of in between at 13%. Looking at the asset class returns again.
Sorry, Anthony,
yeah.
just take one step back there. Sorry, I'm going to ask the stupid questions, and I'm going to assume I'm not the only one. If we go down the bottom, we got the S&P 500, that makes sense. We got the NASDAQ, that 5 makes sense. We got the S&P ASX, which is Australia. I'm looking down the bottom at your key, basically. Then you got the FSE DAX, the Euro. So that's Germany, basically.
Correct.
Then you got the SSE Composite, which is China.
Yeah, Shanghai.
Okay, so that's 3.6% for the year. Then you got the Russell 1000. What's that?
Russell 1000 is 1,000 mid-cap and small-cap companies in the US.
Okay. And then we got the FTSE 100, which is England. And then we got the Hang Seng GR. Which one's that?
The Hang Seng is also China. So China have two main indices. They've got an onshore and an offshore. So it just gives you they're fairly similar. The one is more local Chinese investors, and the other one is more offshore coming into China.
Got you. Okay, great. Thank you.
Brilliant. Cool. So the asset class returns, you can see here in July, MSCI emerging markets was the clear winner there throughout July, largely driven by that strong return from China. On a year-to-date basis, they're still kind of middle of the pack. Most of the rest of the EMs there were kind of doing the heavy lifting. China's, like we saw on that chart, they're lagging quite a bit, which I'll chat to shortly. Commodities came back quite strongly in July. Again, they were lagging quite a bit on a year-to-date basis. They still are lagging quite a bit, but nice to see some flows coming back into the commodity space again, largely driven by a bit more of a positive sentiment around China. Small caps doing well. That's propelling their year-to-date return up quite nicely. It's a sector that we focused on quite a bit in our earlier market commentaries. May have been a bit early on that call, but it seems to be washing through quite nicely. Then we've got value. Again, also some good returns coming out of the value space. That was the key winner of 2022. But it's nice to see value coming back online again. Developed market equities up 3.4. REITs, global REITs up 3.4. Growth, which has been our clear kind of standout winner on a year-to-date basis, was taking a bit of a backseat throughout the month of July. Still, obviously, massive year-to-date growth throughout the course of the year. And global aggregate, which is your global bond market, up 0.7%. Again, nice to see the bond market coming back online again. We're starting to see some interesting developments there as inflation starts to come down, and bond yields remain elevated at around 4.5-5% in the US. You start to get what's called real yield, and real yield is essentially your bond yield minus your inflation rate of that particular country. So you're getting real growth on your asset. So good to see that coming online. That sector is getting a lot more love of late. Okay, then just a brief. I'll stay on this slide whilst I just kind of talk to the key commentary around July and what was moving markets. In the US, we saw a rate hike up 25 basis points. That moves the terminal rate from or to a range of 5.25% to 5.5%, which is high for the US, but hopefully we've seen the peak in the US of interest rates. The next decision will be data dependent. That was the guidance by Jerome Powell at the Federal Reserve. So that's kind of been his guidance throughout the year. It's always data dependent. It's always a wait and see what next month's data is going to tell us. We do have Fed minutes out this afternoon, so I think that will give us a lot more clarity around their thinking at the moment, and whether in fact we've peaked. CPI, our consumer price inflation in the US was probably the major market mover for the month of July. We saw headline inflation fall to 3% from 4%. So quite a big swing there, quite a big drop to the downside. It was more than what analysts were expecting. So that had some really positive, it created positive movements in the market. Core inflation, our more accurate benchmark of inflation, just as a reminder that excludes food and energy. It was slightly stickier at 4.8%. That actually printed exactly the same as the previous month, which we would have liked to have seen some decreasing there. However, I think there was optimism around the fact that it remained as is and didn't move upwards. So some bright spots starting to show in terms of inflation. GDP in the US was up 2.4% quarter on quarter for quarter two. That was some really, really positive news. There were concerns that the GDP numbers were going to slow down a bit. Obviously, GDP is quite an indicator or a lead indicator for recession. So those kind of strong positive numbers point to a soft landing, meaning that the US is more than likely going to be able to avoid a recession. That was a word that was thrown around a lot at the beginning of the year. It was almost guaranteed that the US would find itself in a recession, but they seem to be navigating that path really, really well at the moment. So those risks are starting to wash out quite nicely. Again, gives a lot of strength to the market and buoys it quite nicely. In terms of the consumer data, which has always been a point to pay close attention to, because it ultimately speaks to the end consumer and what their financial position is like. The data was still strong. So what that kind of tells us is that these rate increases, whilst they are helping inflation, they're not overly impacting the consumer, which is a good thing. So you don't want to kind of kill off your consumer whilst you're raising interest rates, because that's really what leads to a recession. So the consumer is still looking strong. And that also points to a potentially higher for longer interest rate environment. So if the Fed knows that they can keep interest rates at 5.25% and the consumer is still going to be strong, then they know that they can hold it there for a bit longer, really get that inflation to wash out the system without causing the consumer to struggle. So again, if you look at those kind of numbers and you look at this asset class return map, so that's largely why the growth style lagged a bit. So growth assets don't traditionally like a high interest rate environment. The reason for that, without getting too technical, is they typically price their cash flows and their discount models into the future. So the higher the interest rate, the more discount they take on their forward cash flows and the more expensive their debt is. So the growth style doesn't enjoy that higher for longer. However, value doesn't mind it. Hence, you saw that kind of shift between styles, between growth and value throughout July. It was something that I alluded to in the previous commentary update. And when we were talking about the big seven and how they had really been the key driver of returns year to date on the S&P 500, I alluded to the point that we will at some stage start to see a shift away from that big seven, away from your more growth orientated names and into more value orientated stocks. So we started to see that throughout July. It's a good sign. It's definitely not a bad sign. It's good because when you get widespread return throughout the market and you don't get a concentrated return on a specific few stocks, it points to a much more healthy market, a healthy driver of returns, meaning that everyone is kind of contributing as opposed to a few single names. So it obviously diversifies that risk quite a bit, from an index level like the S&P 500, and it really creates an environment where everyone is pulling their own weight. Moving over to Europe, the European Central Bank, the ECB, raised interest rates by 25 basis points throughout July. They're sitting at 3.75%. The tone after the raise by Christine Lagarde was quite dovish. And that really means that they are potentially also nearing the peak of the interest rate hiking cycle. She alluded to the fact that, again, it's data dependent, but she was quite comfortable with the way things were going, the way inflation was coming down. So we may have seen the peak in Europe. Again, fingers crossed for something like that, but just to note that it is data dependent. If we see any wild swings, that could all change. We have seen energy pick up, or oil prices pick up a little bit in the last couple of days, which can be problematic if not managed, but it was a small pickup. It wasn't anything massive. It wasn't like last year where we saw oil at $140 odd a barrel, still around the $80 a barrel mark. Moving to the UK, the UK has always been a little bit of a problem child for us. This year, they also raised rates by 25 basis points. That was at their August meeting, was a few days ago, if I'm not mistaken, on Monday, I think. So they've raised rates now. They're currently at 5.25%, which for the UK is incredibly high. They've still got serious inflation issues. I was actually having a look at the data just now. It came out this morning. Their inflation dropped less than expected. So they're still really struggling with high, sticky inflation. So I don't think it's the end of the hiking cycle there. I think we might see a bit more come out of the UK. China also on a year-to-date basis, a bit of a problem child. They cut rates also this week, if I'm not mistaken. They cut rates by a further 15 basis points. It really doesn't seem to be helping. It's quite an anomaly when you think of the rest of the world raising rates and they kind of in this deflationary environment and they're cutting rates and trying to stimulate the economy. Doesn't seem to be helping much. They're still under quite a bit of pressure. Even though we saw that pick up in July, a lot of that has kind of washed away throughout the course of August. I do have some charts on that I'll get to shortly, but just to keep in mind, China, whilst there could be signs that they're reaching a bottom, there's also signs that they're in a bit of trouble, which I'm going to chat to now.
Sorry, just quickly.
All right. So the first chart on the left
Sorry, Anthony,
yeah.
just before you go there was a question from Rob. Sorry, Rob, I've made it so that everyone can chat to everyone now. Would you mind just going back to that sheet and just explaining the difference between a growth asset and a value asset?
Sure. So on a very high level, growth is considered your more tech orientated shares. They typically they try and grow their business and create shareholder value by ways of share price appreciation. So they all kind of revenue and profits that they make from their business activities, they typically reinvest that back into the business and back into new opportunities because they're of the belief that they can generate far higher returns on that capital versus paying it out as a dividend to shareholders. So they're quite aggressive on their growth strategy in terms of reinvesting revenue and profits. Value is somewhat the opposite. They focused on paying out revenue or profits to shareholders in the form of a dividend. They've typically reached the end of their growth phase. They're not looking to aggressively reinvest into new projects and things like that. So that's kind of the key difference between the two values. Also considered if a share is trading at a lower price relative to what their fair value is deemed, they can sometimes fall under the value category. But it's typically what they use their free cash flow to do, what they do with it. Does that make sense?
Yep, thank you. I mean, in simple terms,
Cool.
like, and again, tell me if I'm wrong, but a growth stock is Meta, as in Facebook, or Amazon, or, you know, Alpha, which is Google, you know, and and the value stock is, I don't know, Unilever, or what's a international one?
Coca-Cola.
You know,
Yeah.
something like that, you know.
Spot on. So do yourself a favor and go look at the dividend yield of Meta or Alphabet or things like that. You'll struggle to get 1-2% out of those guys, if anything. So they make it very clear that they believe that they can reinvest their free cash flow better than a dividend yield of 4-5%. They can compound that at a much higher rate, and that shows itself in the share price appreciation, and that's how you derive your value from it.
Perfect.
Cool. Okay. So just back to China. The first chart on the left is China's inflation, their CPI. And you can see there that it's trending sharply down. So they're facing some serious deflationary pressures, which again is a complete anomaly when looking at the rest of the world who's trying to rein in their inflation because it's gone too high. China's got the opposite effect. Now, when this starts to happen, they fall into a balance sheet recession, which is ultimately a situation where the private sector or the consumer is deleveraging. So they're looking to pay off bonds on their houses, pay off their cars, pay off credit cards, things like that. They're not taking on more debt. So when I spoke about the fact that China had cut their interest rates by 15 basis points in the last few days, it's powerless. So monetary policy kind of completely falls out the window in a situation like this, because no matter how much you cut your interest rates, if your consumer or your private sector is not making use of debt, you're not stimulating the economy. So just for basic kind of economics 101 is typically guys will cut their interest rates, or the countries will cut their interest rates when they want their consumer, you and I, to spend more, take more debt, borrow, buy houses, buy cars, buy things like that, and just prop up the economy. But when the consumer doesn't do that, it becomes quite a blunt tool. So China's facing that at the moment, which is quite a concern. They're a big economy. They typically generate they're a big contributor to world GDP. If you're a South African, they're heavily reliant on commodities that come out of SA. So it creates a little bit of trouble amongst the emerging markets, in particular, as well as global markets. So that's something we're watching quite closely. It will be interesting to see the Chinese policymakers and the big government officials are on their annual retreat at the moment, and they typically come back from that with quite a bunch of new policy updates and new plans and things like that. So we'll see if anything positive comes out of that, which I'm assuming it will. But it's an economy to keep an eye on. If we go to the top right, the first number of the week there, it contradicts what I'm saying, but it also helps create an investment thesis around China potentially being very, very, very close to their bottom, if not at their bottom. So the number of the week is 16%, and that's really the tourism number. So the domestic trips that the Chinese people are taking within the country have increased by 16%, which is good to see, because again, that's that kind of activity that you want to see within an economy to kind of prop up the numbers. You want to see guys getting out of their houses, going on holiday, spending money, being active, traveling, spending money on flights. That's all positive. So what China's trying to do, and what their problem is getting their consumers to spend money. I think they've been so shell shocked by what's happened over the last year 2 years with regards to COVID and lockdown and things like that, that they're actually just that they're almost petrified to spend money and leverage themselves again, because they're very uncertain around their kind of outcome. So that's a good number to see. So hopefully that picks up a bit more. We start to see a lot more activity on the ground in China. And that helps boost some of their metrics. Okay, moving away from China and just ending off again with the US. I've got another number of the week there, which is quite an interesting one of 12%. And really that's saying that historically, after the S&P has had a 5-month consecutive rise, so month-on-month increases in the S&P 500, the following 12 months have typically generated a return in excess of 12%. So that kind of bodes well for the situation that we're in. The S&P has done that successfully throughout January to end of May. We've seen a bit of volatility this month, which is interesting, and actually it was expected, and it was wanted, in the sense that if you kind of just cast your mind back to the year-to-date numbers, we've seen the major US indices run extremely hard. So it was inevitable that at some point there would be some profit taking, there would be some repositioning, and really what that's done now is it started to create some attractive entry points. So if you're looking to go long equity and you want to buy equity for the future, you missed the kind of year-to-date rally that we've seen so far. These are becoming quite attractive entry points to get some long-term exposure. Dropping down to the chart below that. So what that shows is it looks like a very confusing chart, but it's really just the implied probabilities of interest rate hikes. And this is looking at September, which is the next hike, or potential hike, or the next policy meeting. And basically what you can see there on the far right of the chart is that the market is anticipating no change to the interest rate. So in other words, a hold, not raising rates, not cutting rates, but really that this chart kind of backs up everything I've been saying around the US potentially being at its peak at the moment. Obviously, we're going to take a lot of guidance and a lot of understanding from what they say this evening, but ultimately they should stick to this kind of consensus. Lastly, just some interesting reading I was doing at the beginning of the week. We've seen in the US a lot of the hedge funds and institutional investors, so your big banks and things like that, they've been using this recent dip throughout the beginning of this week to load up on more tech and any AI related businesses. So again, if you're a fan of following the big institutional guys and the hedge funds, you could potentially be looking for entry points in some of the big tech names, as well as some of the guys that have kind of AI or are AI centric, so have some kind of underlying link to artificial intelligence. That's been a major theme this year, but it looks set to continue. Yeah, that's me.
Awesome. Thank you very much. Appreciate it a lot, Anthony. In terms of it, as always, thanks. If you can just share that with me. I know you normally do, if you probably have already. And then I'll just put it in the WhatsApp group for everyone. And Alex had a good idea as well, which we will aim to create a little cheat sheet around those key metrics, just so people can take a look at it going forward. So thanks for the questions. Any other questions? I know we're sort of on time, but any questions or any thoughts that anyone's got, either put your hand up and talk or just put it in the chat box. I see that Cynthia is going to sort out problems for China by raising her prices, so they can come on holiday to Italy and spend more money. Anything else from anyone? Nope. Okay, cool. Anthony, wonderful, dude. Thanks so much for the update. As always, I learn a huge amount. So thanks so much. I really appreciate the update in terms of the process.
Excellent. Pleasure, Scott. Cheers, guys.
Cool. So we now pivot, and I can see that Gary has joined us. We're going to be running through commercial real estate, London residential, large scale. And just to remind you, I want to tell you a quick story of how I learned about this the first time. Many of you probably have seen this before, but it was 2008 and we'd had the global financial crisis. And up until then, I'd actually met Gary. In fact, I'd worked with Gary selling individual houses, or more so apartments, that people would come along and they would buy the apartment, they would get a mortgage, and they would get a tenant. I actually remember a very funny story. Gary was out in South Africa with another guy called Ian Cohen, and we were running an exhibition, and it was actually the day that Lehman Brothers went bankrupt, which was the 12th of September 2008. I don't know how many people remember that. And the day before that, literally the 11th of September, we had run a road show in Pretoria, and it used to be so effective. People would come in, they would learn about investing in London, then they would, they would meet with they would choose their unit, they would meet with a solicitor, they would sign all the paperwork, they would get their mortgage in place. And I remember a gentleman coming in on Monday morning, the day Lehman Brothers went bankrupt, and he literally was like, he couldn't believe that he came to a presentation and walked out with a property in London. And so what I'm going to share with you today is, Gary and his team, perfected, and I'll let him talk more to it, of how people went around the world, and they went to Hong Kong and China and whatever, and helped people invest in individual properties. Well, in 2008, it all changed quite quickly overnight, because a lot of these developers like Barrett Homes got themselves into trouble because they had sold a huge amount of property off to investors. And I remember an opportunity where, these guys had 48 units, and we could buy these properties. They were fully tenanted, fully furnished, and we could buy them at about a 40% discount. And I remember saying to all our investors, I don't care what happens with market rentals in the short term. This represents a real opportunity. And I mean, I don't know, Gary, if you even know this, but we could buy those properties at £160,000 each in Wimbledon. And it was phenomenal. Anyway, there was one small problem. We needed £10 million to be able to buy all 48 units. And I went along, I tried to get all our investors. We had 2,500 investors. I tried to get them to participate, and I just couldn't do it. So I went to Barrett Homes. I said, well, look, can I buy a unit on my own? And they literally laughed me out of the room. They were quite condescending, to be frank. And that's when I started to really learn about the difference between what I'm going to call mom and pop investing, which is where you go out and you buy a house or you buy an apartment retail from an investor, versus institutional investing, which is where you buy a large asset at an institutional level. And for this asset class, and I'm not going to bore you today because Gary's with us, but I do remind you that in the module 3 of Wealth Going Global, which you all have access to, I've taken you through the key characteristics of London residential, the different property types, the locations, the rental market, the purchasing of property, the market trends, the housing affordability, property management, and ultimately what it's all about. So I'm not going to repeat it all, but this is all in module 3 under the 15 different assets. What I do think is important, though, is that the whole purpose of what we do at the Mastermind is actually to learn directly from the partners. So I can give you all the theory. I've done that already with Wealth Going Global, but Gary has been in this game for a lot longer. And I want to give you again another story. So a development that Gary was part of with Bellway Homes is this one called City Peninsula. And this, again, we help people invest in this at the back end of 2008 when the crash had happened, and the beginning of 2009. 32 people actually bought properties here. And there was this one gentleman, Don from Rensburg, that bought 4 units at £313,000. And we managed to get a 26%. Gary, I don't know if you remember this, but we managed to get a 26% discount off Bellway Homes. And that gentleman, those properties were finished around 2011, 2012. Gary's company, Life Residential, actually managed those properties. I'll let him talk to that, but they've now got 7,000 properties under management. But interesting enough, Don sold those properties in 2021 for more than £1 million each. So it's not too bad to buy something for £313,000, have positive rental for the best part of 10 years, and then sell them for £1 million each. And so without further ado, Gary and I have walked a long journey together. I think we worked together for the first time in 2007, 2008. And I wanted to share with you quickly just his story. Sorry, I thought I had it on the right page. Just give me 2 seconds. So basically, he created his completed his business commerce at Wits in South Africa. So actually, an old South African. Then immigrated to London. How long ago, Gary, did you go to London? So I'm not 100% sure, but it's 25, 30 years ago. I don't know exactly how long ago.
30, feels like 30, feels like 50, but probably I came here in 87.
87, wow.
35.
Okay. And yeah, I don't know, maybe I should hand to you and you can kind of tell your story because you probably know it a hell of a lot better than me. But without further ado, I wanted to hand to
And I
Gary.
can embellish it better.
Pardon?
I can embellish it better than you.
Yeah, please do. Please do. So I think I'll finish off and hand over to you to say, you know, Gary's a developer. He's been on the ground in London since 87. He, you know, started out, certainly my experience of selling other people's developments. And he was as I understand it, the guy that sort of invented the furniture pack and then rental guarantees, etc., and would sell hundreds, if not thousands of units for other developers, and then finally said to himself, well, why doesn't he become a developer? And ultimately created City and Docklands, and I'll let him tell his story. But what I found fascinating was that I actually got reconnected with Gary about, I don't know, a couple of months ago. And there was a gentleman called Ben Grant in England who is a very wealthy and 3-generational family. And Ben said to me, look, I'm talking to this developer. He's realized that, you know, selling off units is no longer the way to go. It's about, you know, large scale investment at an institutional level. I really think you should talk to him. And I was like, who is it? And he said, Gary Sachs. And I was like, oh no, that's bizarre. We've gone full circle in nearly 20 years. So Gary, without further ado, I'm super excited to invite you here. And I'm going to share a little secret if you don't mind. Gary is actually on holiday because most people in London or from England are on holiday in August. So can I share where you are, Gary?
You're going to anyway.
Hopefully all hold thumbs that the internet holds, but Gary's sitting on a boat somewhere in Europe. So anyway, his internet is working from his boat. So anyway, over to you, Gary.
Scott, thank you very much, guys. Nice to meet you. I've just looked at the profiles. I think most of you are from South Africa, so I can talk in Afrikaans.
Gary, so just to be clear, we've actually got a lovely diverse crowd. So we've got South Africa, Zambia, Swaziland, Australia, New Zealand, Ireland,
cool.
England, Germany, and Italy.
Okay, cool. Lovely. Nice to meet you all. Yeah, so I mean, Scott, I've known Scott for years, and just to give you some brief color to my background is I left South Africa in 1987, having finished a BCom at Wits, went to London kind of with no one, didn't have papers or anything. My father had a furniture business in South Africa, so I kind of just opened up a little furniture shop in a place called Kilburn in London, and literally 2,000 square foot. I think I started off with £350. And what you find in England is people tend to be relatively lazy. And I kind of sitting in this furniture shop selling 3-piece suites and carpets for £299. What I started doing was, you recognized there was a huge rental market. So I started going around to the local estate agents and in essence saying to them, we know you're lazy, but you need furniture for your apartments. Because at that time, it was very difficult to evict a tenant in England if they had their own furniture there. So you could kind of lock the doors, but they had every right to go and collect their goods and chattels. So it became quite a big thing to rent, to put your own furniture as a landlord. So I'd phone up an estate agent and say, look, you know, if you need a bed or something, we'll deliver it, we'll give you a commission, etc., etc. And we started building up a business. It then became acutely aware to me that the Chinese were buying from Hong Kong and Singapore, very savvy buyers in the London market. So I kind of went off to Hong Kong, went through the equivalent of the yellow pages and went calling on estate agents in Hong Kong, and came across, at my last meetings, a guy ordered like 12 furniture packs, and they were expensive. I mean, £15,000 a piece. And I suddenly had a small little shop doing £120,000 a year to doing like $500,000 a year, and kind of built that up. In that time of doing that, I then realized, I guess where my drive has always been was to cut out the middleman and to create a frictionless position. So I started I realized that I had to be with the developer at the exhibition to really sell furniture packs. And so we started going and endearing ourselves to the various developers and started going off to Hong Kong and Singapore. And we'd go to Hong Kong. I mean, I can tell you a bizarre story where the weekend before September the 11th, we sold 120 apartments in Hong Kong. That was already when I was developing. We sold 120 apartments, we sold 120 furniture packs, and we signed up 120 people for management. We came to South Africa on the Wednesday after September 11th, and we sold another 110 flats, bizarrely, in South Africa. So it's been quite a strong growth pole. But what we realized was we had to be at the exhibitions to get the substantial sales. What happened then was the developers would always have a loss leader on a development. So they'd say a one bed from 199,000, and then the next flat would be 225. So I kind of worked it out. I was at all the exhibitions and I started buying the loss leaders. And that had a twofold effect, because the developers liked to have me at the exhibition because they knew that a few flats sold. And I would 2 days later then go and flip that flat. But it was different times. It was very different times. Legally, it was much easier to do it. It was much easier to get individual mortgages, etc., etc. So I kind of, in my head, came up with this kind of theory, and it was really simple. If I could buy 10 flats, if let's just say the market price was 100, and I could go and negotiate to buy 10 or 20 flats, I could get them for 90%. Okay. Well, what our strength was, we started offering a rental guarantee. So just to put some background to that, as the market in London, in Hong Kong, the developers started offering rental guarantees. So it made it much easier for the purchaser, because they could come and buy, they'd get a rental guarantee. And it's normally the first 2 years, which is your kind of bumpiest ride, getting a tenant, building finished, etc. So it kind of worked. And in order to have a rental guarantee, they had to buy furniture. So it was great for me. You know, someone took a rental guarantee, go and see the furniture man. Then what happened was, as the market improved, and it literally did get to a feeding frenzy. Just for example, I remember going to one exhibition where we started off on a Friday at £650 a square foot, and ended up at £850 a square foot. I mean, that's ridiculous over a weekend, and that's purely market driven. And it's interesting to what Scott said earlier about discounts. You know, you buy something at a discount. My belief is a discount in property, who knows what the discount is, because you don't know what the developer starts their price at. So it's all relative to income, in my opinion. But that's a different, we'll come to that discussion afterwards. And so what we started doing was, we started seeing every managing director's wife or partner becoming an interior designer. So my competitors were suddenly selling furniture packs at £8,000, and that became a problem for me. So I thought, well, you know what, if I was selling a furniture pack for 15,000, and now I'm only getting 8, that's £7,000 arbitrage. If I lose that money because I take on the rental guarantee, I'll still be in a better position, which is exactly what we did. And we started a rental guarantee. So if someone bought a furniture pack, they got a guaranteed rent. And actually it worked really well, because I've only ever seen rents drop once in England. And that was just after 9/11. And the reason for that was they dropped interest rates to stimulate the economy. So, and at that time you could get a mortgage very, very easily. So what would happen is someone would steam in, not do the maths, just go and get a mortgage at like 1 or 2%, and then clearly that kind of created that real credit bubble, which then, as we know, collapsed in 2008. But what we did in the interim is we transitioned ourselves from selling furniture to becoming a lettings agent, which, as Scott says, now we're managing 7,000 properties over London, and only in London. And also we pivoted into becoming a developer, because where we were buying 5 flats, 10 flats, we then would buy a whole development, etc. And that's kind of as we grew. Then came kind of 2008, and just to put some meat on the bone of what Scott was saying, we were doing a development in Canary Wharf of 630 apartments, of which we had pre-sold 300 odd to the Asian markets, China, Singapore, Malaysia, a bit to Dubai, and 300 odd to the Irish. The Irish were prolific buyers, because, as you know, the Irish banks were throwing money into the economy. And when it came to completion, not one of our Irish clients completed, and every single one of our Far Eastern clients completed. And I think that was just down to a cultural view. The interesting part is those Chinese people that probably bought in Canary Wharf at about £500 a square foot, and still today would sell 1,000. So they still did well. And yeah, at that time it was interesting because so we were left with these 300 units. We were borrowing from Bank of Ireland, Barclays and Deutsches was an agency deal, but Bank of Ireland were the lead bank. And I'm not sure how many you're aware, but in 2008, the Irish government formed a national bank called NAMA, which took over all the debts. So all of a sudden, from having a development where we were pre-sold to suddenly have a development where we still owed the banks £100 million. And what a lot of people did, developers, they kind of went that had access to cash and would go to the Irish banks and say, we'll offer you 50p in the pound, which they really hated. What we did was, and to be fair, we didn't ask the bank if we could rent them out, but we knew as the property manager it was the right thing to do. The bank would have said no because they it would have weakened in their mind their security, but in fact it was improving it. And so when we used to get interest bills, we paid them because we rented everything out, and they left us alone. We were one of the very few companies that repaid the Irish banks in full. And I must tell you, out of interest, that post that period has done amazing things for us, because when we walk in and you can say to a bank, and they can do the checkups, because these bank managers kind of move around and say we paid in full, it gives us huge credibility. So that kind of brings us on to post 2008 and trying to develop. And in 2009, I was doing a development. I don't know how many of you are familiar with London, but by the Excel grounds, which is just east of Canary Wharf, we had permission for a 27-story tower. There was no money available. And I'm sure many of you have heard of a guy, Nathan Kirsch, ex-South African or South African, Swaziland people will know him for sure. But a very wealthy man with a huge cash and carry business in America. And I approached him just on a whim. And I said, I wasn't really looking for investment, but what he did was he basically pre-purchased from me, I don't know, 30 apartments, if I remember correctly, at a price, and he funded it. But what he said to me at the time was, Gary said, we've checked you out. We know your track record. We know what you've done. He said, I don't know how clever you are. He said, but I'm not even worried. He said, because even stupid people can make money in property. And he said, just don't sell it. Okay. And that kind of, it rings a bell. It's great when you've got a business making, I think they make $600 million a year. So it's fairly easy to say that. However, it rings in your head. But the problem with that is you require massive capital. I fortunately had a piece of land which I managed to get a phenomenal planning permission. I had a 0.6 hectare piece of land in West London, which was actually where both my furniture business and my estate agency business was. Subsequently, we actually closed the furniture business, but I managed to get planning for a 42-story tower, a 30-story tower, and two other smaller buildings, which suddenly gave us huge imputed equity in the site. And we took the decision, and it was a bold decision because we could have sold it for a lot of money, to actually continue to develop it. And at the time when I started to develop it, I was kind of the idiot that was developing in the middle of nowhere. And then kind of you finish the development and you're the hero because it's 100% let and it's a phenomenal building. And kind of that's kind of the background to the story. And I'll do a little presentation now, but it really dovetails into what Scott was saying, on the basis that in the old days, it was pretty easy for an individual to walk into an exhibition room, buy an apartment, get positive rent all the way through, and then sell it at a profit. I'm not sure those days exist anymore. And however, the underlying asset is still exactly the same. So what I found is with let's call them my competitors, because in the property business, one day you're their competitor, the next day your partner, okay, because of the joint ventures that happen, et cetera, et cetera. So, but what a lot of you find is a lot of builders will go into development because they think they can build cheaper, and it's actually just it's a false economy. Because your building company needs to make money individually. It has to be a profit center, it needs to make money. And clearly, if it's building for you as a developer cheaper, something's giving. Okay. So you then analyze, and we analyze, well, what are the frictionless costs or the friction costs that you can take away without necessarily affecting your value. And clearly, by building cheaper, you can just build cheaper. by putting cheaper materials in. So we're talking about a standard quality. And so I kind of, you kind of work out that every time I sell a project, it's going to cost me between 5 and 10%. Okay, between agency fees, bank fees, legal fees, etc. So there's a straight 5 to 10%. If I build it myself, okay, and this, by the way, sorry, I didn't mention to you, but what the theory that I came up with was, if the market was at £100 and I could buy 10 at 90, okay, and then I could go and sell. I got into the story about the rental guarantee. I lost track for a second, but if I could then increase the prices to 110 by being a market leader, by putting a rental guarantee in, then when I went to the bank for the 50% stock that I was keeping, okay, my cost was 70 and the market was 110, and hey ho, we could get funding because we were like at 65, 70% value. Okay, so just coming back to that, so we also obviously worked out, well, if we can take out those frictions, so we can, if we build the property, we're probably 15 to 20% cheaper than my competitor. Okay, so if it's going to cost my competitor £100 a square foot to put a project there, or when I say a competitor at the level of someone buying a finished property. Okay, so you go through the risk curve. The various risk points are, you have to get planning. Okay, that's a completely separate risk profile. It's high risk, but very high return. But I'm taking it from the day you get a piece of land with planning. If I build it, I'm going to have a 15, 20% development profit in it. So I'm already 15, 20% less. I'm not going to sell it. Okay, so I'm going to have 5% less costs. My buyer is not going to be paying stamp duty. Okay, so that's a 5% difference, plus all the setup costs, etc. You then also get rid of the friction of being an individual buyer. Do you want to be the one guy in a 200-unit development that's empty? That, by the way, is why our rental guarantee worked, because I could say to 200 buyers, I'll tell you what, you don't have to worry about your flat being empty. You might have to be 3% less because that's the cost of the insurance policy, but you will always be occupied. And it's really false economies to have a flat empty. If a flat is empty, it's probably because you're charging too much, and you're better off discounting it to the right price and having it occupied. Okay, so that kind of brings us to where we are today. And those are just frictionless costs that aren't affecting anybody. It's just the method of purchasing. And of course, on the finance. Okay, so you can take the various, it's all about, for me, it's all about reducing risk. The asset class that we're talking about, as far as I'm concerned, is extremely stable, therefore low risk, okay, but yet with fairly chunky returns, which will outstrip inflation and cash all day of the week. So we kind of look to achieve 6% cash on cash, okay, as an investment. And that's without any growth. And if you put growth in there, 2 to 3%, we easily at double-digit IRR returns. Okay, and traditionally we've probably averaged about 25% IRR through that frictionless process. You also, of course, on the management are going to get a much better deal if you're managing 200 units than 5 units. So it's kind of from we've kind of taken that view of, even stupid people can make money in property, to kind of analyzing it. And let's say it in slightly more kind of less crass and more intellectual terms. Actually, what it is a macro approach to property. When I say a macro approach to property, it's a well-known comment, and Warren Buffett uses it a lot, saying that macroeconomics will always oversee individual cyclic events in a stable environment. And we'll come to that, because London couldn't really be more stable. We have a lot of crap that goes on politically, but it's like different in the African regions it's a much more stable situation. So in a kind of a flat environment where you're not going to have revolutions and coups, etc., it's a very stable investment. In fact, cap rate returns, I'll give you an idea. So cap rates are produced every month by the bigger agents to say what the investors are buying off. So for example, 2 years ago, when the markets were crazy, for example, logistics were being bought off 2.5%. Okay, like a 45 multiple. Now those are trading at about 7-8%. Okay, with interest rates going up and demand decreasing. Residential rents, residential income was trading before interest rates started increasing at about 3.25. It went to 3.5. It's still at 3.75% now, which is crazy when you think that interest rates are like at 6%. And yet people are still buying residential income at 3.75. These are the pension companies, etc. Right? The reason is because they can take a long-term view. So it's a question of analyzing risk. And when you start analyzing the risk with property, you say the risk of London property is reduced, so you can go through the motion of trying to reduce everything. The last final risk position is your debt. Okay, so for example, we on our largest development, which I was talking about, I'll go through and I'll show you, 700 units. We were, I'd like to say fortunate, but I'd actually like to say clever enough to fix our interest rate 3 years ago at 0.7%, okay, for 15 years, okay, because what we're looking for is stability more than anything. So what we've seen in the last 2 years is increase in rents by about 18% and no increase in interest rates. Now, I remember some of the younger guys saying to me, why are you fixing interest rates? And you kind of say, well, we're borrowing about 100 million. So if I fix at 0.7, my upside is 700,000, but my downside at 5% is 5 million. So it's kind of a no-brainer. And I think I'm older than most of you guys, yeah, but you know, and you and the guys in South Africa will really get it. I mean, you guys are used to high interest rates. Okay. Well, I remember in South Africa before I left, interest rates went to 25% at one stage. So I kind of in my head, and I've always grown up in my mind, interest rates 10%. That's the cost of money. It's 10%. It's kind of just as a thumb to work at. Okay. And if you're not getting 10% or more, you're not working your money hard enough. So if you took for a riskless investment and you said, I'm going to buy a property in London, okay, and I'm going to buy it for cash, I would challenge any of you to show me where the risk is. Okay. There are, of course, there's managerial risks like sitting tenants, but you have that anywhere in the world. And in fact, in London, your chance of getting a sitting tenant out is probably stronger than anywhere in the world. It's a pain in the backside, but you know, you can do it. So I think, Scott, let me go through my presentation because it will give you a bit of color as to what I'm talking, talk through the risks. I think that's the most important. You just got to excuse me. I'm not so technically advanced as Scott. How do I share a meeting, Scott?
There's a big green button down the bottom. Go share screen.
That's the one. You can see I build buildings better than I.
Gary, with all due respect, I always say to people, we're not asking for Harvard lecturers here. We're asking for people that are actually on the ground doing it. So we're far better to learn from the experience.
Sorry, I'm just having to allow my computer to do it.
No problem.
Okay, I just need to give it permission. Sorry, guys, I'm on holiday. Here we go. Okay. Can you see that, guys? Presumably.
Yeah, we got you. Yeah. Just want to put it into, just go to view and just put it into PowerPoint slideshow mode.
Do you know what? I can't
Okay.
because it's on a PDF.
Don't worry, just leave it as, that's fine. Just leave it as is.
So I'll just increase. Can you see it?
Yeah, it's perfect. Yeah.
You guys will get the gist. Okay, so that actually is just a view of, that's the building we built. It's quite a prolific building in London. It's we actually got permission to go from 42 to 57 stories halfway through the build. And by the way, we built that right through COVID, no price increases. Yeah, and we delivered. That's the tallest building outside of Canary Wharf in London, by the way. Okay, you got that slide?
Yes.
Okay, so let's start off with why property. And you guys are probably here because I'm probably telling you how to suck eggs. But you know, and by the way, anybody want to ask me questions, just fire away. I prefer that. Okay, so really the story for London property.
Sorry, Gary. Can I make a suggestion? Let's let you remain in your flow. But if people have questions, please can they just type them in the chat box? We will have time for Q&A and we can come back. And if it's relevant, I can jump in and ask you. Cool.
Okay. So this first slide, and I'm very happy to share the slides with everybody, is that the demand supply curve in London is absolutely at the worst it's ever been. You've got an increasing population in London. the graph can show you on the right just how bad it is. But the number of startups in London itself is so limited. And now there's a few reasons for this, obviously.
Sorry,
We
by
have
startups, you mean new property construction?
New builds, right? So we have a horrendous planning regime in England. It's horrendous in many respects because it just takes forever. It's pathetically political, etc. Like say most countries. But on the other hand, if you know what you're doing, it's bloody good because you understand where to go and how to do it. Okay. But what's happened in the last years? Let's just take COVID. No one started a new building during COVID. So you had 2 years of non-building. So just to give an idea, London needs about 60,000 new units per annum. Okay. And the average over the last kind of 5-6 years has been 20,000. So you've got this huge shortage building up. You then also, and now obviously coming out of COVID, okay, you've also now got the financial issues. You know, most developers cost out and they cost it to sell it. So a developer's worst nightmare is what we have at the moment: increasing interest rates, okay, and no sales, etc. So their costs are going up, and they're not creating sales. So they run the risk of debt default. But what we haven't had is we didn't have a crash, right? If anybody didn't realize there was huge inflation coming after COVID, they need to go back to the economics books. Okay, it was the most obvious thing that was going to happen. And so developers didn't build. So there's huge amount of planning permissions given where developers aren't building. So I get this newspaper called React News, which is a daily kind of what's happening in the property market in England. And it used to be on not a daily, but every 2-3 days, there'd be an article about so-and-so got planning permission, so-and-so started building, etc., etc. Nothing for the last 2 years, honestly, nothing. Okay. On top of that, we had quite a big contractor go bust, building 35 projects in London. Now, for those of you who have done some development, there's nothing worse than a contractor going bust, where you have all your warranties, which you have to get, and you have to carry on building. I've had it once, and it was an absolute nightmare. So now you've got 35 units, developments in London at, say, average of 150 units. That's another 5,000-6,000 taken out the picture for at least a year, because they won't be able to mobilize for that. So the headwinds for actual development are huge, which has just impinged on the shortage. And it goes back to what I was saying about the value of a property. What is the value of a property? In my opinion, the value of the property is the income it creates, okay? And it's all to do with your own cash flow that can define where you buy. So if you could buy something in Mayfair, for example, which gives a crappy return of, say, 2%, over 25 years, I guarantee you it will be a phenomenal investment as well, because it's very limited supply, okay? So as long as your rents come in, it will catch up. So we kind of cut our costs accordingly. We can't afford a Mayfair, but what we know is that for sure, we'll rent out the stock we've got. So just to go back on our life residential business, which we're managing other people's properties for, we have Scott did embellish it, but it's not 7,000, it's 5,300 odd. But I think our vacancies at any point in time, and it's a day in time. I think last would have been July, I think there were 60 units which weren't occupied. And that was mostly through churn, because someone's moved out, they have to repaint a flat, etc. And by the way, that's on a background of 13% increase in rents, which is really simple. It's part inflation, but majority supply and demand. So going back to the whole stupid thing, it's a macro policy that property ultimately will go because of supply and demand. Supply and demand will outstrip any other cyclical position that you have. Okay, so I think you're probably all convinced about property simply because you're here in the meeting. But and then just going to why London. I mean, as I said, we've discussed that supply imbalance. I'm 100% convinced of it. Do you know, on that unit, that tower that we did, 701 units, we've only sold 200. We've kept the rest, and we literally stabilized that building in 1 month. Literally in 1 month, had it fully occupied. Okay. London's economic stability is not great at the moment, but nowhere in the world is. Okay. By comparison, life's all relative, right? So I'll tell you a little story. I've got a friend Okay, he's got no financial problems. Okay, nothing whatsoever. He reads 3 books a week, goes to gym twice a week. Okay, everybody wants to have sex with him, and yet he never stops complaining about being in prison. Okay, so it's just quite an interesting analogy, because life's all relative. So London, whilst we have a world economic kind of downturn at the moment, London is still pretty stable, even with our crappy politics, etc. The fact that we talk politics so much just proves actually how stable it is. Okay, we don't get out a gun, we don't shoot, we kind of do what we have to do. And interestingly enough, actually the economy is not doing so badly. Interest rates coming down, or our inflation's coming down slightly, etc. But we've been through this before. Plus, it's still, without question, the center of the world, okay, from a democratic point of view and from an economic point of view. It's crazy to think. I always wonder how on earth we can be the 6th largest economy in the world, but we are, you know. And we building up the tech side. So there's a whole lot of reasons why it's so strong. And of course, the last one being the you know, it still kind of doesn't matter how you move the map around. We tend to be the center of the earth for some particular reason. I'm sure that's just the British colonial vision of what the world should look like. But right, we'll come to us. I won't talk about this too much, but City and Docklands, we've been going for 25 years. Our Life Residential manages the small individual units. We have a brand called AWOL, which is a way of living, and it's really a consolidation of what we do at Life. So we have a full brand, which is, sorry, let me just say, just for a start, in London, there's been a huge transition from individual buyers, such as Scott was saying, to a more corporate buying opportunity. So what they term PRS, private residential sector. So you never had pension companies investing in residential up till about probably 8 years ago. It was always by Tesco shed or by logistics warehouse or an office in the West End or the city, etc. And slowly but surely they started moving into multifamily properties, which is much an American and a German model. And if you think about it,
Gary,
what it really is.
Gary, sorry, can I just butt in there? For those of you who remember 2 months ago, we had that lady, Fiona from Knight Frank, that runs the Wealth Report. And she was talking a lot about this massive trend worldwide to PRS, which also in Australia is called co-living. I just wanted to kind of join the dots for people in terms of what you just said.
Yeah. So, and in fact, is Scott, in actual real terms, what you're actually just seeing is a move. Okay, so the theory is fairly simple. You've got people that have got money and you people that haven't got money. And I hope you can see my hand gestures. But what happens is when the economy grows, it doesn't grow out like that. It grows like that. And the people at the bottom tend not to look up and say, or look down and say, oh, we've come up 3 inches. They look up and say, look at those people, they've gone up 4 inches. So, and what happens is the rich get richer and the poor get poorer. And basically, the rich are educated. They know they have to cycle money down, but they're not stupid and they don't turn around. They're not gracious or charitable. So they don't turn around and say, we'll give you the money. They say, you know, we'll lend it to you. Now think about what rental is. Rental is the ultimate form of credit. Okay. So if I go back 60 years ago, you couldn't buy a car on credit. You bought it for cash. You know, I remember my father was so proud. He had an old Galaxy, it was called a Galaxy, a Ford Galaxy. And then, you know, the clock got turned back when necessary, etc., etc. These things, they become more disposable now. So what rent is just avoiding someone to buy a house, right? So you don't have to find the money, etc. So basically, it's in a holistic way, it's big corporates recycling the money and not selling the stock. Okay, so that's where it's developed, and it's become so lucrative. And right now, as I said before, it's still showing a cap rate of 3.75. So the view of what the market will become is very, very strong. The difference between like the pension companies, etc., going into PRS and what we're doing is their time to market is so long. Okay, they're very bureaucratic decision making. They can't jump on a bandwagon ever, etc. And then, of course, our service that we give in AWOL, way of living, is a huge added benefit. You know, a building is just the concrete. The people that come into it are the blood, the the energy behind the building. So just for example, in our buildings, we'll have a Saturday drop-in once a month. We have a doggy, what did they call it? It's like a barking breakfast where everybody with dogs will come in. So for example, just on the rental market, the most searched for words on prime location on the rental market is inclusive bills and pet care. Okay, so we know that pets came from a COVID. A lot of single people started getting pets, so we made our building pet friendly, and then included bills, and that goes the same as the rent. People just want to know in a transitional world today, they just want to know what's going to cost them per month. Okay, we also, by the way, have we're a regulated housing association. So for every development we build, we have to supply an amount of affordable housing as part of the planning permissions. And instead of kind of fighting it, which a lot of people do, we kind of embraced it, kind of said we need to give something back. And you know what, just as it happens, we still make a profit from it. But it allows, again, the transition, because if I go and sell that stock to another housing association, again, I've got commissions, they've got stamp duties, etc. So this way I can maximize my income. Okay. And what we tend to do is we look in regeneration areas. Okay. And it's fairly straightforward. The reason is, in a regeneration area, if I'm confident about it, whatever I can buy and build for now is going to be cheaper than in 10 years' time. So the two good examples of regeneration in London is King's Cross. Okay. A company did a massive development there, and it's been very successful. But obviously the ones that I'm sure you all know about is Canary Wharf. And that's kind of where I cut my teeth in Canary Wharf, because coming from South Africa to London, most of the properties were old, kind of 1940s onwards properties with the kind of damp, no mod cons. And yet suddenly in Canary Wharf, there were these brand new buildings, all like, you know, flat screen TVs as part of the deal kind of thing. And it was so much nice to live. So I kind of gravitated there, and I started supplying furniture, building, etc. And but what they did at that time is that, yeah.
Can I just tell you a quick funny story? So 20-something years ago, I was working for Shays, who I know you still work with today.
Were you? My
It
contract.
It was 2001. I did my degree. I did my honors degree in construction management. I got a cum laude. I'd done my master's degree from Greenwich University, cum laude, and I was standing 2 stories below the Thames River in mud, in the rain, you know, on a construction site in Canary Wharf, literally building there. And I remember just thinking to myself, geez, my life, what has happened to it? Like it was, but I think my point being is I literally, at the same time you're talking 20 odd years ago, like I watched Canary Wharf, you know, all those residential, the Docklands and whatever get built. And it's phenomenal what's happened in those areas.
Come on, let's put that slide on then, Scott, to put a bit of color to it, right? Okay. So it was crazy times, and you have to remember, and I'm very thankful for it. I did take advantage of opportunity, but I mean, at the age of like 35, I had a credit line from the Irish banks of about 200 million pounds. So it was kind of, you know, life was kind of a bit different. It is much harder now. And it has to be more thought through. But the point of the regeneration area is, if you look at the picture on the left, that's worth one value. The picture on the right is worth a different value, right?
So
I mean, I experienced it.
Gary,
my parents.
I don't want to assume everyone knows their way around London. So if you can use your mouse, just point to where like the sort of city of London is. So, I mean, sort of top right corner.
Okay. So Canary Wharf is kind of East London. So going that way is the City of London, and in fact going that way is the City of London as well. But I mean, that clearly, and that building is the same building with nothing round. And in fact, Canary Wharf was built. There was no infrastructure there, so it was, excuse me, a hell of a big risk, because there was no transport, etc. But what I was going to say is they formed the London Docklands Development Corporation because it straddled like 3 boroughs, so it made it easier. So. And I'm going to tell you that because I'm going to lead on to something else now, is because, so what we do is we pick the regeneration areas, okay? And I add in another layer to the point that I was saying about frictionless growth. So if we take a piece of property in a regeneration area, we get the planning and we build it, okay? And we get the rents based on the regenerated position, okay? That's suddenly when you're going up to double-digit IRRs, 20, 25%, right? Okay, so let's just take a building, let's take your real prices. Let's say we're building a building for £500 a square foot with a notional value that we think would be sold at, say, £650 a square foot, okay? And all of a sudden, that development, that location, because we bought in the beginning, we took a chance on the regeneration, suddenly it's at £1,000 a square foot. Or you can look at it the other way, the rents are based on £1,000 a square foot on your cost of 500. Okay, it doesn't take long to see that you don't have to be that clever in property. Okay, so what happened was we were always based in West London, and West London has never been really developed, yet it was the main industrial, it's always been the more expensive side of town. And so what they did, there's an area called the Old Oak Common, Park Royal, which used to be where the old Rolls-Royce factory was, the old Vickers factory, famous kind of stuff, moved out. And it's this big swathe of brownfield. I'm sure you're aware of what brownfield is, which is old industrial sites looking for development. And basically they decided they were building this train line, HS2, which is a train line from meant to be Liverpool, but that's going to be cancelled, but Birmingham into London. It's a huge construction. It's the biggest construction project in Europe. And they decided to put the main station in Park Royal. Okay, so we already had a presence in Park Royal. So we've kind of endeared ourselves to the local authority, which is now called the Old Oak Common Development Corporation. So again, we take some frictions because we do get an easier ride in the planning. The reason being is simply because they know we're going to deliver. So at the moment, we're delivering 1,250 flats of a 10,000 unit scheme, and they now minded to make us their official delivery partner, okay, which I think we will achieve, but already the most prolific builder there. So, and I'll send you these stats just to give an idea, but this is you get an idea of the kind of connectivity. And in London, or in England, but in London particularly, it's all about connectivity. So in that, and this is the reason they decided to put the station there, because they already have the new Elizabeth line running through, they have the central line, and they put in the train line. So it becomes the most connective area. So if you just take prices, and Scott, you probably know prices better than me now in Canary Wharf, but they probably hovering around £1,100–1,200 a square foot. Whereas in this area, we're still at £700–800 a square foot. But let me put some perspectives. If you look at the times, to Bond Street is 9 minutes, okay, which we still zone 2 in this location. Okay, so Canary Wharf, I think, is zone 3. So the connectivity, and that's what it's all about. Hence, we managed to get our building rented in the space of a month, right? So just, and why else West London? That graph there comes from our rent figures. And if you have a look at the various areas, and again, Scott, you might want to just send out a piece about the local areas, but if you have a look at that bottom line, we're kind of, well, not the bottom, the second to bottom, that's West London rents, okay? The one on the bottom is Birmingham. Now, what you do, if you take that Birmingham rent and add in a train fare into London, you'll find it's the same price as West London. And let's be fair, people are living in Birmingham because they can't afford London. The gap in Birmingham and London is reducing. So what will happen is people will start gravitating back into London. So, and that was the point about the regeneration. So we're expecting that gold line of West London to probably move to North London and the city, the blue line, okay? That is free growth. That's the regenerative growth, okay? And that's how you can go from saying, if I went and bought a flat on an individual exhibition, I'd be happy to get 3 or 4%, okay? How on earth do we end up getting double-digit IRRs on our investment? And it's a whole thing of this coupled with patience, right? If you can take the debt away and you can be a cash buyer, you don't even have to worry about increases in interest rates, which is the final risk, obviously. So, and coming back to value, when we value a property, we first take the rents, okay? Sorry, let me just come back to that. We first take the rents and then work out the value, okay? So for a normal developer, the biggest nightmare comes, they build, they can't sell. That's my second price, right? So I go in and I say, I'm going to work it out based on rents. Rents do not peak and trough the same way as prices do. Okay, they steady and they steadily increase. The graph is like that, as opposed to the graph for capital values is like that, right? So your planning is much better. So if you plan for war, which is the rental side, and hope for peace, what happens is we're never going to get into trouble. So we'll rent out the property, and all that will happen, we'll sell it in 2 years later or 3 years later, or not at all, just really depending on your time. That, again, is another reason for us looking at a fund, because people can then come in and out of the asset class without being reliant on having to sell a property, go through the motions, speak to an estate agent, make sure they get in the price, get all the legals done. Okay, you still want to be in the asset class. You want to be in the asset class, but it's being run more efficiently than you could do it individually. And you can come in and out because everybody's circumstances change. What I will say, I've had friends forever that come and said to me, oh, you've done a right in property. Can I buy a flat from you? And I always say to them, I say, yes, on one condition. Okay. In fact, I'll give you a guarantee. I'll buy back your property at whatever you paid me for it, but you have to tell me you're holding it for 20 years. Okay. Because that is really the lifetime of an asset like this. Okay, so if we recognize that if you do it as a fund, you can save a lot of money, you can make better returns, you can do it more efficiently, and you can allow people with smaller pockets to come in and out. Okay, that's essentially where the market has changed to. Okay, so if you remember this picture, which I showed you before, and it's about having the vision, that is currently, in fact, the picture on the right is probably now about 8 months old. But just to put in perspective, that is the old a yard on the left, this here, an old rail yard. This here was the old Rolls-Royce factory, okay? This is London, okay? That's central London. In fact, that's Canary Wharf on that side. This is a park called the Scrubs. It's the third biggest park in London. And this is the station that they're building. And Scott, I think you actually saw some more of it, but it's huge. Okay, it's a huge redevelopment. This was the plan for the center of the area. Now, if you look on the top right corner here, that was before we started development, that's after. So you can see the difference. So when we started estimating rents, we actually built this building many years ago, the one over here. And when we estimated rents for this building, we kind of said, well, we know we're going to get 5% more over time. We know we're going to get 5% more because there's a Crossrail station here now and a tube station here. And then we also said, well, we'll probably get 10% more just because the building is there. And if you look at that top right-hand photograph, it kind of shows you what a difference that can make. Okay, so you can see we started, that's our 2 buildings there going up. This is also all part of the station redevelopment. So you were looking to the right that way when I show you the photograph. This is all being developed, right? And you can see it's coming up. This building here is owned by Imperial College. So just let's come back to London. Imperial, the student education is a huge, huge export for England, huge. Okay, so Imperial College have moved their main campus from Knightsbridge to White City, which is 4 minutes by tube, and they try to locate all their lecturers and staff here. So, for example, these 3 buildings over here have got planning permission. They're owned by Imperial College and will be built. It's about a £2 billion development. But what you can imagine is that location where say that building might have cost me £600 a square foot to build. By the time they start building, it's going to be 800. By the time they start valuing, it's going to be 1,000. And I've had huge uplift on that building. And all along, I've had very strong positive income. I was very lucky in the fact that I fixed my interest rates. But the point is, if you're doing it with very low debt, it shouldn't be a factor either. Okay. Just to give you some other background on us, just on what we've done. And the whole point of this presentation is property in today's world is a long-term hedge against inflation. Okay, if you want to do this and you want to treble your money in a month, you have to buy in a very high risk profile environment. If you're happy to just beat inflation and maybe do better, which we obviously believe you will, then this is a good thing. So you can kind of see we've built 3,000 odd units. And all these dark areas along here are recessions, and we're still in business. So, it just shows you what that kind of does. And this is just kind of the developments we're doing. This is the current development. We're doing 2 developments at the moment. If I just go back up to this, if you look at that, right, that building there. So this is taken from the 57th floor of our tower, because we got extra planning permission, as I said, during COVID to go higher. And that's the building there that we're looking at, which is that one there. Okay, so we've got two buildings opposite. We are keeping in our own company this building, which is 241 units. And Scott, you were asking me earlier, do we have any opportunities? We have this building here, which is 208 units, which we're building it. We're at second floor slab. It's a debate whether we keep it for ourselves or we're going to take in investors. And it really, depending on the feedback from you guys, I guess we'll see. But to be fair, it's a 200 million pound project. But we will rent it out. The other very strong part of what we do is when you build two buildings together like this, okay, I can reduce my gross to net. Okay, so let's just say you take £1,000 gross rent. Industry standard now is about 25% leakage for agency fees, management costs, etc. Building two buildings like that, we've managed to get our fees down to about between 19 and 21%, depending on the building. Again, depending what we throw into the building. Like, you know, we did a summer party. In fact, if you guys go onto on Instagram and have a look at, I think it's called AWOL something in London, you'll see some of the parties that we throw. So it really depends on what we spend. But like in a building like this, we can have one gym, okay, instead of two. You can have a few less concierges. Okay, so our model, by the way, is, as it really is a thumb, we want to be in at between £500 and £600, and we want to be getting £2,000 a month rent. £500 and £600 a square foot and getting £2,000 a month rent. That's kind of our nice point where we are, and we understand it. So these two buildings.
Sorry, Gary, let me just get that clear for everyone. So you wanted the build cost should be around £500 to £600 per square foot, and you want to rent it out for 2,000.
Sorry, not the build cost, the all-in costs, Scott. The all-in cost. So land, build it. Yeah. Just to give you, you can go and work the maths out yourself. Average flat 700 square foot. So it's like 5-6%, maybe 7% gross if we're clever. Get a little bit of an uptick because of the regeneration. Save a little bit because our gross to net is stronger, and hope there's growth. But I just think, and that was the point of you going back a full circle, demand and supply and demand will guarantee growth. Okay, just to be
clear on that number. So it's 500 to 600 sort of all-in cost, and then you look to rent that out for 2,000 a month. Is that what I'm hearing?
And that's just a really, Scott, that's a rule of thumb, so I can think quickly whether development's viable. Okay, it's obviously not that. We're actually achieving better than that. But the point is, if you just take, and it's all about relativity, right? The £500-600 cost to a purchaser buying an individual flat would be closer to £750 a square foot, because they're going to add on, say you're at 600, they're going to add on 20% developer's profit. You're at 720. So what you're trying to do is move the 720 to the £500-600, right? You want to rent out through your own channels so that you're not paying a high commission in rent. You want to run them effectively, okay, so that you're not paying too much in expenses to get your net rent into a stronger position, okay? And you want to finance cleverly. And if you do that in a place like London, which should only have growth and not a decline just because of supply and demand, if anybody can try and find out where the issue is, where the weakness is, I'd be interested to find that out. Okay. The problems become from too high leverage.
Let's just repeat that, because I'm writing it down, but I'm sorry, I'm doing this on purpose. So we've got the 20% developers profit. We've got rent out so that we're not paying sort of the high rentals that people generally pay.
Correct.
And then we finance cleverly.
So for example, the other one is more efficient operations.
Okay.
Reducing our gross to net leakage.
Got you.
So like if you went as an individual purchaser to like a life residential, you won't get less than 10% management and rentals. Okay, we're doing it for 6% for our own stock. Okay, and it adds up. It adds up to a lot of money over time.
Well, to be honest, it's even more than that, because that's the ongoing management, and generally there's a placement fee for a tenant. So you're often upwards of 15%. I'm talking in general. I'm not talking life. I'm just talking in general. You know, in London, you're generally renting out for 15% plus.
Correct. But it's all a matter of time. You got to be patient in this game. It's not like there've been many occasions where we could have exited and taken a lot of cash out, and you don't, because you in our business you don't see a lot of cash coming out. It's an asset and wealth generation process. Until you get off the bandwagon, okay, you don't see any money. So, like, just for example, any fund, we completely private. We have no third-party equity investors whatsoever. Okay. And we've always, like on this fund that we're looking at, we seeding it with 30 million pounds. So we in it, etc. But we for us, we haven't got unlimited capital. So the building on the left that you can see there, that is a 400 million pound development, okay, which we did on our own without any other private investors. Okay. That's the building, just to give an idea, that's the building I did with Natie Kirsch. That's the mayor's office now. That's the cable car, the Emirates, quite well-known Emirates cable car, and that was the tower we did. And this was the development that we did. This one over here was the one in Canary Wharf, of 600,000. So I think, Scott, that's the presentation done. So we'll stop sharing it.
I've got a bunch of questions, but before I go to those questions quickly, and if anyone has questions, please chuck them in. I'm going to leave you on pin so that people can see you. So there was a question from Ross. What are the size of the units? So, we've spoken about let's call it the model you've got. What sort of is your average kind of size unit that you're renting out?
I'd say average now is about 700, 720. It really depends on the development and the and what government policy is at the time. So if you imagine an average one bed is probably 620, 650 square foot, and an average two beds probably 780, 800. So I just work on 720 as an average. Obviously, you will get better returns for smaller units, but it's an interesting concept because what you're calling co-living in Australia, in England, co-living today is like 250 square foot units, small units with shared kitchens, shared lounges, etc. Now that's just that's a matter of taste, whether you like that kind of living or not. It tends to be quite expensive, okay, and people don't tend to do it, but like. We have, if you work on £720 a square foot, an average size of an apartment.
And just to make it easy for people, because I'm not sure everyone can convert as easily, generally the rule of thumb, just divide by 10. So 720 square foot is roughly 70 square meters, roughly. Like,
listen, from a bit of an older, wiser guy that's got experience, if you can't make it work, because the actual calculation I think is 10.76, right? Yeah. And the actual rent might be 2,050, and the actual cost might be 520 or 540. If you can't make it work with those small margin changes, you shouldn't be doing it. Which is why it's a good way sometimes to work on rule of thumb, because if it doesn't work on rule of thumb, it probably doesn't work.
Yeah. So talk to us, Gary. I'd like to. You have sort of referred to it already, but I want to kind of talk about this. Because you've been part of this change almost more than anyone I know. And what I mean by that, as you said, you were selling hundreds and over time thousands of units, where Jill and Joe Soap, whether they were in Dubai, South Africa, Hong Kong, whatever, were going into a hotel, they were buying an apartment off plan from a developer, they were buying a furniture pack, they were getting a rental guarantee, they were being, funded by the bank, generally at probably 70% mortgage. And they were putting 30%, down, and then Life Residential was not only giving them the furniture pack, but renting it out for them long term. And that was sort of the model, let's say, 10 years ago, in terms of, and it flourished for 10 or 20 years like that. Now what you're saying is that it's changing, very much so to this institutional approach. And you've already spoken quite a lot about management. So I think everyone understands the change in what's happened with management. But I'd also like you to talk a bit about tax, because there's been a lot of change in England around the individual, let's call it mom and pop investor, and how the tax situation has changed in terms of owning individual apartments and houses?
So it's interesting. The tax thing, I kind of always like look at it and say, well, tax tends to be an at the time political decision. Okay, so so England had a perception that people from overseas, predominantly Hong Kong and China, and the Russians to some degree, were buying houses in London, flats in London, and the houses were empty. Now, maybe from a Russian person buying a massive house in Belgravia, that's true. But certainly our market, the government was really misunderstood what was going on. Okay, the Chinese were buying. What they're doing, the actual asset, the place that someone in England was going to live was in England. And actually, it was the best export England could do. So money was coming in from overseas to fund these developments, right? So there wasn't a housing shortage. And the money is coming. It doesn't matter that the ownership is overseas. What's the difference? People turn around to me and say, oh, you've made so much money. And say, yeah, but you know what? I don't have it in my bank. I'm not living in Monaco, okay, having a party. You have usage of the properties. Better that I manage it with a bit of savvy to manage these buildings than someone else that doesn't understand it. So actually what the government did was, from a political perception where commentary was, look at all these overseas buyers coming and pushing the prices of properties up and leaving them empty, caused the government to say, oh, we need to stop that. Let's whack up stamp duties on second homes. Another reason why we have such a shortage of properties in London, because a major source of the income for development, because most developers have to get pre-sales before they build. We already at that point where we managed to build without pre-sales, but they turn around and say, well, I can't do the sales, I'm not going to build, right? So it's like this worst scenario. So from a tax point of view, the stamp duties were increased, but that happens all over the world, Scott. So where would you feel safest? And this is my point about London, right? The South African government, the Zimbabwean government, any of the governments, the Australian government will put taxes up tomorrow. But ultimately, if you have a look at those guys that we dealt with 20 years ago buying in Hong Kong, who were probably paying, let's be fair, 10 or 15% over the odds, very savvy, have made a lot of money, as you said, right? Okay, so it's a question of you have to go into it on a very specific financial metric, which says, I'm going to buy for 100, I'm going to rent for 6, I'm going to gear it, say 50% because I can get borrowing at 4 and work it out. Then you can say, what are my risks? My risks are I don't have a tenant, very low risk, and even lower now. And you can see what our premise is, why we think is low, just supply and demand. The risks, we're not going to get the government doing a land grab. Okay. So there's this whole lot of things that you could go and say it's all stable. So the tax I tend to ignore, if that makes sense. And if you're paying tax, you've made a profit. Don't complain.
I know, but I think
so it's
right.
all
You are right, but I think what you've already alluded to it. There's also been this tax change where individual investors can't write off interest against their tax. I'm talking local.
Oh, correct. Yeah.
Which meant that it's actually affected supply even more because there's less and less people going into the buy-to-let sector, basically.
Well, Scott, it's affected supply, and it's also given you another reason for frictionless change to individual ownership to fund management. Because when I sell,
that's where I'm sort of alluding to is that there's
that's
a change
exactly
in ownership pattern from what I call mom and pop investing.
Correct.
I'm going to come to you and buy a unit off you retail versus partnering with you and investing alongside you.
Correct. And we keep it really simple, Scott, because we just charge a simple manage. If you come in at the level of doing the development, which obviously has its risks, although we, as you say, you work for O'Shea's, we've used the same contractor for 25 years. And we've done at least £1 billion with them in construction costs. So, we understand how to manage that risk. And it's just about managing the risk. We understand how to manage the rental risk, etc. So it's kind of, you want to take out all the costs that are pointless costs, like stamp duties, like management fees, etc., and then you'll get a better return. But yes, you're correct. That is why there's been a move to that, and it's curtailed supply. It's like a double-edged sword for us.
Yep. Tell me, in terms of you mentioned actually in the meeting that we had, and actually, funny enough, it came from Ben first, and then when you and I chatted. where you sort of made it, you alluded to where your original buildings you built and then sold, because again, the traditional model was for a developer, build them all and sell them all. And you said something along the lines of you wish you had actually just kept them, like, which is what you're doing now. Talk to us a little bit about that mindset shift for you, because it talks to, remember, we're trying to teach people here around the mindset of what they can do over the next 10, 20 years. And so learning from past, I'm not going to say mistakes, but experiences is very valuable, you know?
Look, you know, it's not a mistake because you have to cut your cloth accordingly. So when I first came to England, you know, I couldn't even think about buying a flat. How I managed to do it was when you're in Hong Kong, I could put down £1,000. I go and buy a flat and then sell it the next day for £20,000 extra. Okay, I mean, it wasn't being that clever. It was just circumstantial, and sometimes you fall into that pot. And I guess the cleverness or the not the luck part was taking advantage of that situation. And we did. I mean, I can tell you stories where I went, I had an office in Singapore of selling furniture, and I knew a woman that she used to come to exhibitions. She was a lawyer, 5, 6 flats, and then sell them to her clients. And they all made money. And I had agreed to buy 2 small flats in a place called Lisson Grove, which is a very good postcode, but not such a good location in the postcode. But I bought these flats for like 165,000, and I met her in Singapore and she said, "What's happened in the London market?" I said, "Well, I bought these 2 flats at 185,000. So I'll take both of them." And then she said she phoned me back the next day and said, "Can you get any more?" I phoned the developer. He had like 32 more 1-beds, agreed a deal at like, I think 180, and sold them to her for 225 the next day. I never put down a penny, and made like £1.5 million. And I'm thinking to myself, whoa, this is a good business. But I mean, you know, those things happen. Like that's like that moment that you strike oil and think, geez, I've just struck oil. And kind of, I guess what I did do was I didn't blow it, and I kind of just built on. And Natie Kirsch said something very interesting to me. He said, building property is like, it's like building a wall. He's put down 1 brick. He said, then put down a 2nd brick. Don't think about it. He said, and before you look around, you'll have a wall. You know, and I think that's what it is. But obviously, it's the capital constraints to get into this business is huge. It's enormous, right? That's the whole point. When I managed to get leverage with no personal guarantees, and you had £200 million line from the Irish banks because they were getting money from Europe at like 1% and being pushed to wholesale the money out. It was unbelievable. Okay, so it's a different time. So now, if you have to adapt to the market, the bottom line is property as an asset class is a long-term investment. Okay, not if you're a developer, but then it's not property, that's your business. You know, there's a famous commentary that says that basically if you can have a third in your business, a third in property, and a third in cash, you'll have a very stable position. Okay, now my problem is my property side and my business side are both property, right? So what we tend to do is we look at the investment side of our business and say that's our property portfolio. And we look at the management side of our business and say that's our business. Just happens to be in property, but it's our business. And then you want to just keep the cash to avoid the risk of high interest rates. So, you know, it's not out of lessons I've learned. It's about desire to hold and build wealth, and then having to cut your cloth accordingly. Hence, we didn't sell the site. So just to give you an idea of numbers, I bought that site for £11 million. I probably spent £4 million speculatively on getting planning. The day I got the planning, the site was worth 70 million. Okay, and I could have easily sold it and taken the cash out, but I didn't. I kept it and went with the further risk of then building it, etc. But why? Because my desire was not to get 50, 60, 70 million pounds. My desire was to earn every year the income from it ongoing. It's as simple as that. And then you have to just get into the asset class based on what amount of capital you've got. Now we're doing an asset raise. The reason we're doing a cash raise is because we have this phenomenal track record in London. We have this phenomenal relationship with the largest regeneration area in the country. We're the only providers they own all what they call Network Rail, which is a rail company. Where they're doing the station, they own all the Network Rail property, and they want to deliver 10,000 homes. Okay, so we kind of turn around saying, right, next generation of my family, et cetera, coming up, we have a huge opportunity here. Huge opportunity. Okay, a few some of the Investec guys are getting involved now as well, because it is a massive opportunity. It's like rebuilding Santon, you know, coming up and saying, oh, I've got an idea to build Santon somewhere. It's the same thing that's happening. So there's huge opportunity. But the capital constraints, they're talking about a £4 billion GDV development. So what we're looking to do is we're raising £1 billion, and we also doing individual deals with small investors. Like let's just say we need £10 million to do a development. We're saying to people, okay, well, you can own a part of 100 units. And we're very transparent with our management side of it, you know, like we do it at kind of cost plus 10% kind of thing, just to cover our overheads. Because we know we'll get the benefit by managing more, we'll get more savings.
Tell me just, let's compare that now. So, you know, it's what I'm going to call 2023 model of investing, where you're investing alongside a partner, and yeah, you're getting you're investing in 100 units, and as you say, you're getting cost plus 10% as to the value, you know, et cetera, et cetera. What's your thoughts on that versus what's quite common in South Africa at the moment, and I'm sure it's in other areas as well? You know, these guys they'll tell you, they'll send you on a course, and then you go and buy a property in Wales, and then they, you know, it's some old, I'm sorry to say it, but some old shitty flat. And then they're going to, you know, bring in a little contractor, and you're going to renovate the flat, and then you're going to kind of, you know, they've got their own management team, etc. You know, blah, blah, blah. What's kind of your thoughts on, I mean, I just look at that nowadays, and I'm just like, I mean, I've done it thousands of times myself. It's just full of so much hassle. But, you know, what's your take on kind of where the world's going, you know, again, over the next 10 years? Obviously, you've got a vested interest. Obviously, you know, have an opinion, but more importantly, you've got 30 plus years of experience, which I'm hoping to share with investors, you know?
Well, it's a fairly simple answer there. Where would you rather be, in London or Wales? So if you plot that curve, plot the risk curve. It's all risk related, right? Your returns in Wales probably a bit better if it all goes right. That's a big if, right? So it depends. Are you that greedy you want 1% more on your money? Or are you that looking for stability, that you want stable growth over a period, but guaranteed growth? You see, it just depends where you come from. I'm at the point where I'm more scared to lose my money than to make more. Okay, so I have to be very conservative. Okay, but my conservatism has always produced like 20. Let me just see if I can find you another slide while I'm chatting. And I'll just give an idea of what this is. This is actually part of our fund slide, and I just want to see if I have got the just want to see if I've got. Oh, no, sorry, I don't. I was going to see if I've got some of you to show you some of the oh, I do. Okay, can I share this with you?
Yep. Well, we don't know what it is, so we just we're saying yes, not knowing what
sharing. Look, no, I'll tell you what it is. This is, can you see that?
Not yet.
Can you see that?
Coming up. Yes.
Okay. There you go. I mean, this is just to give an idea. It's a very similar deck to what I showed you, slightly different. Sorry, I'm going to slightly different because this is actually for our fund that we're raising, and it kind of just talks about the vertical integration, operational efficiencies, etc., etc. And it gives you an idea. But what I want to show you there, and that's a good summary page, Scott, which shows the market opportunity driven by supply and demand, etc., vertical integration and performance track record. But here is the reality of what our IRRs have been. Hold on, sorry, just bear with me. There. Okay, if you can see that, right? And you just have to look at the IRRs we've achieved. That was the first one, by the way, the 521.1% IRR was the one I didn't really have to put any money in. Okay, but those are the true IRRs we're achieving. Okay. And that's the question of whether you want to get involved in that singular flat in Wales, and when your tenant hasn't paid rent, you really have the risk of losing your apartment because you can't fund it. Or you can go to people with a bit of experience and say, you know what, I'm going to put my money with you. You go do all the dirty work. You've planned for the downside. Most people that go and buy that flat in Wales do not plan for the downside. They don't even think about the downside, right? But that this just gives you an idea. The one thing I wanted to show you, I just happened to see the slide, and if you just bear with me, but this was that slide there, okay, is was that the red? No, there. That slide there, okay, that's a Knight Frank. You said you had Knight Frank talking to you, so it's probably done by the same department. That's a Knight Frank index of rents from 1972 to now in London, the black line. The gold line is the same index for, say, purchase and sales. Okay. Brilliant. So it's just quite interesting, that ability.
Yeah, no, that's fascinating. Tell me in terms
so that's why it's much more efficient.
I'm sorry, after
yeah. I'm saying that's why it's much more efficient to buy in a bulk position.
Yeah, and I think something else that's relevant is that
for me earning either a planning profit or a management profit, it's great. I'm happy, but I guarantee you'll be making more than you'd be making on buying an individual flat.
I think
that's the bottom line.
I think the point being as well is that, you know, if I've only got £50,000, you know, literally the only option right now, or sorry, you know, up until a couple of years ago, was to go buy in Wales. That was it, because that's all I could put down on a deposit and own. I couldn't buy in
or Birmingham or Manchester.
Or Manchester or Liverpool. And I mean, you and I have seen so many
Scott,
stories.
just to tell you, in 2008, okay, I had one flat in Manchester that we built because I was trying to endear myself to one of the developers, Crest Nicholson at the time. When the markets dropped, London came back after about 8 months. Okay, London started booming again. Manchester is only just getting back to their same levels.
Well, and I think
just to give you an idea.
What I'm trying to say as well is where you just said buying bulk. I think with where the world's changing, and particularly with where technology is assisting in this process, is that if I've got £50,000, I can't invest in London. It's not possible. Like, I can't buy an apartment for you or anyone else for that matter. I mean, it's just not enough. Whereas now, where you talk about the fund and what you said in a bulk position, people now can participate alongside you and benefit from it without having to own an individual unit on their own. And I think it's just a mindset shift as to why people can actually get back into London when they haven't been able to get into London. And by the way, even if you've got £500,000, I still think personally you're a fool if you put all your money into one apartment, you know, because you've got no diversification.
Yeah. From an investment perspective, 100%. If you're going to look and you're going to live there, or you want a bolt hole or something, it's different. Becomes a home. It's a big difference. People stop distinguishing between a home and an investment. I'll tell you something, the best deals I've done, I've never even been to look at the property. I look at the numbers, I look at the paper, and I go. If you go there and it happens to be a sunny day and it's a top floor flat, etc., you pay more for the wrong reasons.
Tell us, in terms of, you've spoken quite a lot about risks today, which I really appreciate. But in terms of London, the property market, something that people do ask around the world is, you know, what impact has COVID had? You know, are people all sort of moving out into the, you know, into the suburbs, you know, or as they call it in England, the counties, and they're only coming to work 2 days a week? And, you know, how do you see that? And again, you're on the ground. So what are the market dynamics of what's changing around COVID?
It's a very good question. I don't know. You know, it's all bullshit, in my opinion. Okay, so we have this argument every day with who's going to work and who's not going to work. And I said everybody can have a 4-day week. They don't have to come in on Wednesdays. Okay, and it's strange because most people come in. Okay, everybody wants a Friday. It's all bullshit. Okay, I think it's quite frightening from the it's quite frightening from like what the world shows to younger people. okay, and the ethics of work. But again, we're realistic enough to know to adapt. So in all our buildings we're building now, we're putting like a kind of a WeWorky thing at the bottom so that we can rent a desk and a bed. Okay. And but what we try to do is we try and create like a social environment, because that's what people really want. They want to meet people. People are lonely. Okay, people want people. So the problem of not going to the offices, my son worked for Jones Lang for the last 4 years. And he hated COVID because a young kid like 27 couldn't interact with anybody. So it was very difficult for him. So people want to interact. So if we can create both of those, I don't think it's affecting. In fact, office market's gone up at the moment in London. It's very difficult to tell, Scott. I think it's a shorter lived thing. When people start getting hungry, they start eating again, basically. You know.
Ross has asked, what would the investment vehicle be? So again, assuming you're participating in the 10 million pound investment, what would that investment vehicle be, and how would buying and selling work?
So it would just, in effect, it would be shares in an SPV, basically.
So it's basically the way we do all our investments, where there's it's an SPV, you invest in the SPV and it owns the asset, if you want to call it that.
Correct.
I suppose the question is that every investment we have has a timeline. There's generally a timed exit strategy. So how would you see that working? Because what I'm understanding from you is you want to buy to hold. So the exit strategy would have to be willing buyer, willing seller, pretty much.
Well, remember what I said. We plan for war and hope for peace. Okay, so the plan for war is, say, we're buying it to hold it. So if you want to get your money out 5 to 7 years, it's not the right one to go into in the first place. Okay, if you accept your money has to be there for 10 years. However, if there's an event where someone comes and then offers us a hell of a deal, okay, you have to. I mean, it's kind of contrary to what I'm saying, because I do believe you want to keep. But then again, if you are building at low value and you can sell and get that building profit, it's worth selling. So what we foresee is having an SPV with just a few agreements in place, which says we're aiming for X rental, etc. If we get an offer which takes the IRRs above 20%, we will sell. Basically, you come in for the journey. I think what I've never wanted to do was be in a fund where in 7 years I'm forced to sell in a down market. Just stupid. It's contrary. It's completely contrary to why you'd have property and why stupid people can make money in property. Just don't sell it, because I can guarantee if you can ride through the storm, you'll make more money in the end.
But
and that's why I say that's why
earn a passive income.
Risk.
You'll earn a passive income.
You earn a passive income, correct.
Okay.
Scott, if you bought a property in London, a decent rental property in London for cash, explain to me where anybody perceives the risk to be. Can only be political, governmental, something. And in England, it's as close as you're going to get to normality. And you could go and buy in Trump Town in New York, or there's a lot of places I could think.
I mean, I think it's a good way to sort of end off. And I think if there's any other questions, just pop them in. But having the conversation with Ben, and again, Ben's family have been investing in mainly commercial real estate, as I understand it, in England for 3 generations, and he's worth half a billion pounds. I mean, they've got a lot of experience. They know they're part of the who's who, and it was really interesting talking to him. I spent 2 hours with him, and he kind of took me around London, showing me all the different spots. And I mean, it was like a buyer's trip from heaven, if you're wanting to understand the London market. And he said to me, he thinks the only resilient asset class at the moment worldwide is the top cities and residential property. He said everything else, you've spoken already today about industrial, office, retail, whatever. They're all sort of all over the place, and no one quite knows where they're going. But he said, and again, it's such common sense, but he was like, people need houses, and residential. And that's really where the whole conversation came back to yourself with, but rather than trying to go and buy a bespoke unit here and a bespoke unit there and try and manage, let's just say you own 20 buy-to-let properties all over the place yourself. the friction costs and the hassle are through the roof. So the only way to do it is with that whole institutional mindset. And I think just trying to bring it back full circle, you know, that for me is what Ben sort of, you know, started that conversation with me over a year ago. And I'm really, really grateful that a year later, Gary, you hear sharing with people, you know, ultimately how people are doing it at an institutional level and can participate alongside you, but not having to go through an institution. I liked what you said earlier about cutting out the middlemen, because if you go and put your money, sorry to say it, but with Investec, there's going to be 10 middlemen between you and partnering next to Gary. And my logic is, why not just partner?
But sorry, Scott, just for investors' benefits, there will always be a trustee nominated company running the shares, like Investec, for example.
I know that,
just
but what I'm trying to point out is you want to cut out all the middlemen. You want to try and get as close to
of course, you want to cut out all the unnecessary costs. You want to cut out. When I do a calculation of what I shouldn't have paid in legal fees, okay, now what I shouldn't have paid in agency fees, it's phenomenal. It's phenomenal how much goes out in those costs. And the first thing someone says, oh, maybe I'll build the house myself and get it cheap at cost. Well, that's false economies. You know, so yeah, it's a transition. Life is always a transition. You have to be fluid and you have to move with the times. But ultimately, you go to Maslow's hierarchy of needs. People need shelter. There's a few, just going back on the COVID issues, there are a few small little subtle changes. Like someone asked the size of flats. So in the development that you can actually just see behind me on the right-hand side that we're keeping, those flats we've designed specifically with 2 double bedrooms the same size, right? So a lounge. So the configuration of the flat is a lounge in the middle, 2 bedrooms on either side, because you can have sharers then, right? By sharing, you're reducing the rent by 30%, okay? If you can make it into a nice environment.
We all did when we lived in London. You know, we would rent a 5-bedroom house and stick 5 of us in each, or one of us in each bedroom. You
know? Correct. It's the exact same theory. So there are some changes. So now if you can do that and put a desk in that someone can use a desk, you start ticking a lot of boxes, right? The biggest box you have to tick is transport. So these 2 buildings that we're building here, whilst the transport now at the moment, you'd have to walk about 500 meters to a station. Okay, when the redevelopment of the station is done, the biggest station in London will be 100 meters away from this apartment. That's the regeneration benefit. So if you can hold it and keep it and get a small income, be happy. Okay, I promise you, this location in 10 years' time, you'll say, I did it. I bought in Canary Wharf on day 1.
Yeah.
Or I bought in Sandton on day 1. You know, that's just kind of our view. So yeah,
that makes sense. Ladies, gentlemen, any other questions? Obviously, this is a roller coaster of information, a huge amount, and I do have the PowerPoint, which I'll share with people so that people can look at the small print, if you want to call it that, because some of those slides were detailed and people can look at them. But are there any other questions from anyone, or any comments or any thoughts? Hopefully today you've really got a good insight into not only the UK property market, but more so the residential market, and then even more so the London property market and how it's evolving and where the opportunities lie in terms of the market. So I'm not sure if anyone has any other questions in terms of anything else. I've been through my 13 pre-prepared questions, so Gary, you've answered everything, so I really appreciate it.
Yeah, no, Scott, I appreciate it. Like if any of you are ever in London, please feel free to contact me and I'll take you around and show you on the ground floor what we do.
Awesome.
Right. Cool. Hi. Can I ask a question quickly, Gary? Hi, my name's Garth.
Sure.
Thank you very much for this.
Hi,
it's opened up my mind and opened up my viewpoints as to what is possible in investing in the UK. I used to live in London and at the time didn't really have the wherewithal to invest in a property. You know, this was the early 2000s, and in actual fact, I should have geared myself to the hilt because it was a fish in a barrel, right? But
you know what?
Things changed.
2020 vision, right?
No, exactly. So we can't go back, but we can only go forward. And I just really appreciate you being willing to offer an opportunity like this to people like myself who don't have the wherewithal to invest in these massive big developments and things. And maybe that's my cynical question is, why are you willing to offer, you know, small fry like myself an opportunity to invest in a development like this with someone like yourself who has access to funding from banks of over tens of millions of pounds?
Well, I think primarily it's a question of how much gearing do I want. Okay, my business is only geared at about 40%. And I could very easily go and do this myself. But, again, whilst I say there's no risks, of course there are risks, because I will then have to gear more. Okay, and if I gear more, I then increase that risk of high interest rates, etc. And I just don't want to do that, right? So what our model is we're going to, part of the model is we're going to say, look, we're going to expect X return. If you get a better return, we get a kicker. So my other business components kind of are going to make management fees, etc., and they can run. And that's what we're looking for, business rather than the buildings. And why we're offering to you guys, it really and truthfully is just comes through my relationship with Scott. Okay, we are raising a fund and we're going to try raise £1 billion, okay, to take on this area. But invariably that takes time, it takes periods. We have a development now. We don't mind if people want to get involved. We're always happy to take people's capital and invest it for them. We will always look for an increase if we perform better, and it's normally anything over 10%. We get a 20% share of the additional profits. Okay. It's not really a question of taking on smaller people. So whoever wants to do it can do it. What we don't want to do is we don't want to be involved with dealing with 500 individual investors. So with Scott and Scott's ability then to channel it as come as a one, with all of you guys as a one investment kind of works for us.
Yeah, that makes a lot of sense. Obviously, we can pool together in an SPV, and that is the one that's with you, yes?
Correct. And and also, who knows where it leads to? I've learned in my life to treat everybody in the same way, because you'd be surprised when that person comes around and says, oh, by the way, I've just sold my internet business for this and I want to do that. And it's just, and also we want to have a bit of fun along the way. I don't want to stress myself. I've taken enough stress in the last few recessions and everything, and we managed to carry on, so it's not
well, I mean, and that in all honesty shows why investing with you is advantageous for us, because of the stance that you're now taking of saying, well, at this point in my life, I'm making sure that I'm very risk averse, and I'm going to make sure that I'm not going to lose the money that I'm investing, right? And that I think is important. I can tell
you now, we've often done joint ventures with people. Okay, I can honestly say now, we have never lost money on a deal, just because we are super cautious.
Yeah. Perfect.
And that's why if we can take advantage of getting a relationship with the government, okay, where you sign an agreement with the government, where the government says all this network rail land will sell to you at a price, and you just deliver 10,000 homes. It's like, it's a fantastic opportunity. Now, to deliver 10,000 homes, as I said, is probably £4 billion. Well, I'm going to speak to a lot of people to raise that kind of money.
Yeah.
It's to ever. So yeah,
I think also though, Garth, it's kind of, you kind of already alluded to it, both of you, but I think again 10 years ago, you didn't want to deal with even 10 people putting in £50,000, because now when he's got to pay 6% return, it's bloody with bank costs and admin. You've got to have 20 people in an accounting office. But with the advantages of technology, it allows us to be able to participate in smaller amounts per individual, but it still comes to Gary as one check, which is what works for him,
Sure. Okay, thanks.
And then you just you know what, and be very realistic to say what's going to happen in like a year. I can tell you what I don't think will happen. I don't think the markets will drop, and I don't think we'll run into bumps, but I can't tell you what's going to happen in 10 years in terms of growth. So if the opportunity comes and someone wants to buy, great. What I've found now, because we're sitting on a lot of stock, I'm getting approached by a lot of the pension companies to buy our stock. But clearly what I think they're worth and what they think they're worth are two different items. Even if it's a percentage point, it adds up to a lot of money. But what they clearly don't like, they don't like getting their hands dirty like us in terms of actually building the product, getting it stabilized. They don't like that, doing that. They're too lazy.
Makes sense.
We're a real added value. We're a real added value fund. We build it, we rent it, we work the rentals, we monetize everything. We monetize our internet, we monetize our gym, you know, everything we can, we monetize to get the returns better. And we don't monetize it in like a greedy way. We monetize in a real value for money way. So people are really happy with the way they're living and they're recreating this community. They're really happy with that.
Yeah, I think that's so important because you're actually adding way more value to the assets on the ground.
Correct.
And that obviously then feeds back into the value of the assets,
Correct.
in monetary
Correct.
terms, long term. But
You
really,
know,
it's buying a lifestyle. It's particularly in the
Correct.
UK, because you've got to make your time, day to day more enjoyable, more appeasable, because of obviously you've got the
Correct.
weather and everything else that's going on. But
you have
having
to
lived
understand
there,
why there's so many pubs. You know why there's so many pubs in England?
Yeah.
Because people don't want to sit in their homes.
No.
Okay, it's not
No.
like you guys in South Africa go sit out in the great weather and everything. It's shit weather. It's grey, and their lounges are small. They have to pay for eating, so they go sit in the pub, right? So we try to create that social environment. If you guys can go and have a look at our One West Point development, and you'll see it's like amazing. I don't know if I can. If you've got 2 seconds, no, I don't think I've actually got.
I think
I
you
can
gave
just
it to
have a
me.
look
I
here for
think you
1
actually gave
second.
me-
Just give you a.
I think you gave me the thing. Let me just.
You guys are probably. Yeah. Look, I'll show you. This is. Let me see if I can just share this with you guys. Okay. Share. There. Can you see that?
Yes.
Yeah. That's the bottom of one of our developments, One West Point. Okay, look. If I play that. That was 2 weeks ago. People really kind of happy on the ground. Look at this. Okay, so that cost me £14,000 that night. We had drinks, we gave people free drinks, a pizza, etc. On the Monday, that was on Friday night. On the Monday, we had 8 renewals for rentals. Okay, people re-signed their leases for rentals. So it's that kind of lifestyle that you're creating, just more. It's a bit like Soho House kind of vibe. Then we can get slightly more rentals. So you can see we push the rents to premium because of the service we give. We bring our frictional costs down. We bring our build costs down. Suddenly we've got a decent margin. It's why you shouldn't be a day investor on the stock market. Okay, you think you're going to go and buy Coca-Cola because Coca-Cola is going to go up. Meantime, Warren Buffett's got 300 analysts calculating whether it's going to go up or down. How on earth can you compete? It's impossible, right? Same thing.
Awesome.
Okay, guys.
Well, Gary, you've added a tremendous amount of value. As I expected. So Gary, when I first said to Gary, dude, I need you to spend at least 90 minutes, he was like, what? I can't talk for 90 minutes. I'm a developer. But I think you've added more value than we all expected, which I deeply appreciate. And I actually love the free conversation. So, Garth, your questions and other questions, for me, it's the free flowing conversation is always actually better than a PowerPoint. So really, really appreciate the insights from you. There's lots of thanks coming in from everyone. And yeah, Gary, I think long story short, you and I have been doing business now for 15 plus years. I look forward to the next evolution, which is us participating alongside you. And I've taught everyone what the value chain of real estate is. Up until now, I've only been on the bottom end of your value chain as a retail investor, but I now look forward to being alongside you as your partner and using this 30 plus years worth of knowledge, not only to your benefit, to our benefit. And so thanks very much for that. I deeply appreciate it.
Yeah, no, my absolute pleasure, guys. And as I said, feel free to contact me when you're in London or wherever. Cool.
Awesome. Well,
Scott,
enjoy
and
your
we'll have a
pubs.
chat next week.
I'm not going to say I'm not jealous.
I'll send the bills to you. You'll lose the jealousy very quickly.
All right. Cheers, Gary.
Cool, guys.
Thanks,
Nice to meet you all. Thank you very much. Cheers. Bye-bye. Bye. Bye.
Cool. Okay, so let me just get my slide up quickly. I hope you enjoyed that. I never, you must understand, when I invite partners, I try to coach them a little bit, and I try and share what they, what the expectation is. I never quite know what they're going to do or come up with, or, but I certainly learned a hell of a lot. And I've been investing in London since 2002 myself. So I've got 21 years of experience, and I learned a hell of a lot. So I don't know, just in my interest, did you guys, was that valuable? Did you learn a lot from him?
Yeah, I think I certainly did. I think it was nice to see, the opportunities are in that type of structure. Because obviously for us up until now, for sure, it's always been a case of buying a small residential property in Wales, and then hoping to find contractors and find letting agents and find, service people to come and service, plumbing and things like that. But that's a headache, as you said, Scott, that really isn't the best way to invest and to put your money into a property sort of portfolio. So, being able to invest into something like this, I definitely see a huge advantage here. So thank you for that.
Yeah, no, cool. And I can see there's lots of comments here. Mind-blowing, very valuable, great, extremely enlightening. So yeah, no, I completely agree. And look, he's a proper operator. I mean, his story of, I don't think you all fully understood what he said. So, and again, I'm just going to highlight it. Let me stop sharing just quickly. I will go to the admin now quickly, but I just want to finish this. So what you could do in London was you could put a deposit down on a property, and he said, like £1,000 property. Okay. You could walk down the street and find another buyer who was prepared to pay more than you had agreed to pay. So let's just keep it simple maths. You agreed to buy it off a developer for £100,000. But you only have to put £1,000 deposit down. Okay, then you would walk down the street and you would sell it to someone for £120,000. So that person would close on the deal. It was called an exchange. Okay, you didn't have to pay stamp duty at the time. So you would get your £20,000 profit. Obviously, you get your £1,000 back. And you could exchange on the deal, and you could exchange even before the property transferred. Okay, so you've made your £20,000. The building hasn't even been built yet. Okay, like in terms of that process. And so, because what often they would do is they would go and they would take, let's say, like you mentioned, 30 units off a developer and put £1,000 each. They would then come to people like South Africans, Irish, Hong Kong, whatever, and they would make them put down a 10 or 20% deposit. Now, you do the maths, okay? That's how they then paid out their £1,000 they'd put down. So they're out the deal. They've got the cashes, and then they get the profit, the upside. And like he said to you, what he learned was with that Singapore lady, where he bought it for 165, he sold it for 180. She asked if there was any more. He secured another 30 at 180, and he sold them at 225. That's how he made £1.5 million, like in a weekend. So I'm just showing you the evolution of, like, literally a furniture salesman, then basically a Scott Pickett, like an RPS salesman, like selling apartments with furniture and furniture packs, then a rental agent, then going, well, hang on, why didn't I just build it, to now being a wholesale owner. I just want to make sure everyone's understood that pattern. Like, and for me, if you've looked at that value chain of real estate, which I can find just now if people are interested, again, do we want to be retail investors, or do we want to partner right alongside Gary? Now, don't get me wrong. Is he going to make his profit? Without a shadow of a doubt, which are quite like, I think, I can't actually remember who asked the question, but someone asked the question earlier. It was yourself, Ross, asked the question, and it's like cost plus 10%. I'm happy with that. Boom, make a profit, make a margin, go out there, keep doing it, and we'll, I'll be your passenger alongside, So it's the sucker fish analogy is the best way to describe it. But it also reminds me of what I'm going to call true passive income. Because like my one property in London right now, the flippin' oaks get hold of me and Sky's not working, and because the debit order didn't go through and the rates and taxes have gone up. I mean, anyone that owns property knows what I'm talking about. Versus giving him a check and maybe I get sent a picture of that party, but I don't have to manage it. I don't have to run it. I don't have to do anything. Like, I just get my return. Okay. I think enough on, hopefully you now understand what I meant when I used the word, this one here, London residential, but large scale. Hopefully you can see what I mean. There's a fundamental difference between mom and pop investing and doing it large scale. Like, I just want to, hopefully it sort of makes sense to everyone in terms of that process. Okay, just in terms of some admin for everyone, just to remind you that as part of the university, you've all got access to it. You've got Wealth Going Global plus Asset Mastery. If any of you don't have access, let us know. I mean, you do have access, but just in case you don't know, and so that you've got not only access to this session but previous sessions, etc. Also, Alex is always available. So if you want to chat to him, or there's things that you're struggling with, or things that you need help with, or whatever, Alex and I work closely as a team to be able to sort that out. So just go out there and use us. We had a meeting about 3 weeks ago, and we've actually got another face-to-face next week, where Alex and I it's a concern I've got, that we're still not using the mastermind, the coaching, the execution, the accountability enough, and making sure we're moving people through stage 2, stage 3, etc. So it's awareness from our side, and if you see us pushing, we are going to push harder. Alex, I don't know if you want to talk to that, if there's anything you want to say. But I feel that we want to get people active. We want to make sure we're getting results. So and often I know I'm speaking to the converted, the people that actually hear live. Maybe I'm talking to the people who are listening to the recording. But Alex, anything you want to add to that?
Yeah, I think the important part here is that we're going to start reaching out. We're going to build a system that is going to be a little bit more effective in getting results. So yeah, that's one of the key things we're going to discuss next week. So watch the space.
Perfect. At a Wealth Migrate level, I've got some exciting news. I have told you a couple of times that to get new deals onto the platform using the 11-way wallets, etc., we needed to update the regulation, which basically means we needed to update the key individual. We've hired a very high-powered lady who has come out of Nedbank, if you want to know where from. She actually joins on the 1st of September. And we put in our application yesterday to the FSCA to update the key individual. We were originally told two weeks, so I actually thought we'd be live by September when she joined. We're now being told it might be as long as 3, even 6 months, which makes me want to cry all the way to the bank, because there's nothing we can do. It's in with the regulators and what has to happen. So, but anyway, for the mastermind, it doesn't really matter, because we'll still do deals like we've done the DWG one, off platform, and then we'll reverse them onto the platform. The good news is, for everyone that invested in the DWG deal, they pay monthly. I don't know if people are aware of that. And so the first dividends will be coming up in the near future. So, I always joke with people, but when you start to earn your first dividends, it's a bit like tasting something you haven't tasted before in terms of global foreign passive income. So well done to all of you that participated. And that deal has closed. We own it. And the first dividends should be coming up, in the next couple of weeks, which becomes really quite exciting. And then on top of that, I spoke to the guys at DWG yesterday. They actually are looking at a new deal that they are going to send across to us. He said today, tomorrow, I don't know exactly, but there's a new deal that they are trying to get under contract. And even more exciting, in my opinion, was I spoke to Garth Wellman yesterday, and they've got a deal in Europe and a deal in America, which in the next 2 to 3 weeks, they're looking to bring to market. Again, they would normally only bring them to their 60 families that they work with, but he's agreed that we will be able to participate alongside them. The best part is that one of the deals is a $10 million plus deal. Now, we often wouldn't be able to participate in that, because we can't raise $10 million quickly. It just doesn't work like that. It's a 2 to 3 week raise where the deal closes. But he said that the mastermind participants will be able to participate alongside, and whether we are a couple of $100,000 or a couple of $1 million, it doesn't matter. Whatever we do, they'll make up the rest, Kalia. So it's actually, again, a very unique opportunity to invest in an off-market deal that quite frankly doesn't, we wouldn't even know about it, but it's coming. So I did ask Garth to send me some headline details to share with you. And he literally said, Scott, it's at spreadsheet stage at the moment. you know, as soon as I've got something, I'll let you know. So yeah, what I like about it as well is obviously Calio is doing the due diligence on it. So that's very valuable for anyone that's, you know, been through Calio in terms of, I wish I had more to share with you, but I literally spoke, I mean, Alex was on the call, so you can verify the conversation. It literally happened at like Hoppers One yesterday. So it was opportune timing for today, but I don't know any more than what I've told you. So it's basically a Euro deal, a European deal earning euros, and an American deal, both income producing assets. And then on top of that, Garth and his team, so it's the next thing I've got here for next month. But with next month, next month we've got Ann Wilson. So we did a review for you guys in terms of what asset class you wanted to do next. And the one that got the most votes was ETFs. So that's exchange traded funds. It's the most cost-effective way to invest in the stock market. And as I understand it, certainly from my own relationships, Ann Wilson's one of the best in the world at teaching people how to do it, you know, etc. So she's going to be with us. I do remind you, we do always aim for the middle Wednesday of every month, but in September, it's the 6th of September. And the reason being is that I'm actually in France for 2 weeks in the middle of September. I'm going to watch the World Cup. And I'm on a bike somewhere in France. So I've brought it earlier just so that, you know, because I've got no idea what the internet will be like. And then on the 18th of October, so again, the middle of October, the team from Calio are doing private equity. So we've got ETF next month, and then we got private equity in October. So we've got some really exciting things. And then just to remind you with Wealth Going Global, you know, this is really a course that we set up specifically for the mastermind so that people had a very strong base, a very strong foundation in terms of knowledge. So, you know, you can learn there, you know, how to choose the right countries, you know, top 5 countries, how to choose the top 5 currencies, how to, you know, what are the top 15 assets, how to choose the right partners, how to build a wealth plan, and then ultimately how to use technology. And I do remind you that, you know, we hadn't thought of it, but a number of people have been reaching out to me. So if you are interested in some sort of family, and we haven't finalized it yet, I'm just interested in those that are interested, but particularly for your children and, you know, wanting to help them, you know, come through it to be able to get the learning, etc. Just, as I say, just type in the chat box family deal or WhatsApp me family deal, and I'll come back to you. It's a work in progress. But one of the things that we feel very strongly about is generational wealth. And so, you know, I know a number of people that are part of the mastermind want to pass on the knowledge. And so we're trying to work out a way to do that. And then in the final thing for today is just to remind you again that from next month, I'm going to open up a session, because I do find that these sessions are too long. I mean, we're already at sort of 2.5 hours now. And what I've noticed is that a lot of people drop off. And therefore we're fulfilling step 5, but we're not fulfilling step 4. So step 4 is the accountability, the mindset, and the execution. So what I'm going to do is I'm going to make myself available on the same day at 8 a.m. in the morning, so the hour before we go live, for an hour afterwards, so pretty much now for an hour, and then in the evening for an hour. So no matter what time zone people in, they'll be able to check in. And my very strong recommendation is that you use it to just turn up, even if it's just for 5 or 10 minutes, and say, look, this is what I committed to do for the month. This is what I've done. I'm on track. Yes, no, if you've got any questions, etc. Because remembering that the value of a mastermind is to help you move forward every month and to make measurable progress. So just in terms of that process, you know, again, I want to kind of move now to the Google Sheet, and I'm going to, again, you know, model it from my perspective. So what you would do is you basically go to the last month. And if I go here, I basically say, right, what did I say I would do at the end of July for this month? And for me, it was rebuilding step 4 and 5 in terms of automating the mastermind process. So it's in orange. It's Alex, Shane, and myself met 3 weeks ago. We're meeting again next week. The good news is, again, I'm maybe sharing a little bit here, but we actually want to make it. So I don't know if you've seen this quickly. Sorry, what was my game? Just give me 2 seconds. So I'm just going into Wealth Going Global here, which is part of the university. Oh, no, that's not it. Why is it not letting me do this? Come on, man. All it's logged me out now. Oh no, here it is. So the way Shane's set up Wealth Going Global is a fully digital process. So you can literally go through, you can click on everything. If you go to any one of the modules, you can literally, sorry, I've got to sign in. Which kicks me out. But and what we're looking to do for the mastermind is to make it as easy for you using the exact same process. So Shane and Alex and myself are actually building this out at the moment. So that's what I mean by it being in orange. I just want to show you quickly. Why is it not logging in? What's my computer doing? Sorry, let me just log in quickly. I'll just show you what I mean, because it makes it very easy for people in terms of the process. So if I go in and I go to Wealth Going Global, remembering you've all got access to this, and I literally go in, so I click on Wealth Going Global and I can go to the course. So we basically, for the mastermind, going to be creating the exact same thing so that you've got all, it's very easy for you, you know exactly where you're at, you know where everything is, you don't have to go and find stuff. So whether there's, you know, today's recording and the materials, etc., it will all be very easy. So that's what I mean by we're working on step 4 and 5 to be able to get it sorted. And then for us, we've got the KI in place. The lady's name's Lisa. She's pretty much signed up and joining on the 1st of September, which is really exciting for us in terms of getting new deals onto the Wealth Migrate platform, and then equally getting the DWG deal closed. So that for me is the review from the last month. If I go to August, you know, for me, the highlight of the last month was getting the KI on board, closing the DWG deal, and the testimonials. It was wonderful, the testimonials that came through from Wealth Going Global. Some of the challenges is currently dealing with the current custodian, so mainly around communication on the current deals. The real focus to get new deals on the Wealth Migrate platform, and then the work that we're doing with Garth and his team at Calio, because we want from step 1 to step 2 to step 3 to be far more integrated and easy for people to be able to. So again, just to remind you, and I'm hoping everyone sort of gets used to talking in these steps, but this is that mindset where we, you know, step 1 is where you're meeting me to do the outcome. Step 2 is where we, you know, getting clear on the starting point. Step 3 is the wealth plan. So it's these 2 steps, step 3 and step 4, that we're working closely with from a Calio perspective to, you know, with Alex, myself and Calio to make sure that works. So that's really where I'm at in terms of my check-in and my actions. And then my strong recommendation is that you would go and you would fill in your actions now for what you hope to achieve over the next month. So that's me. I want to sort of hand over and find out if anyone else wants to give it a go in terms of the process.
I'll
Sure.
go.
Okay.
Who's that, Diana? Diana, go.
Yeah. If you don't mind, Scott, you can go through back to the other sheet.
Okay, no problem. I'll share again. This, yep, here you are. Yep. We're losing you, Diana.
I don't see it yet. Okay, for July, basically, yes, I said I'd review my portfolio. Based on what I've learned from gold and silver. I've opted to do the fractional purchasing, which I've concluded. And there's some minor things that I need to do with regards to the other action steps that I was considering, which is related to storage-related activities. For August, I took action on the highlight is I took action on my gold and silver initiative that I've looked at. And then my challenges is I'm dabbling around with trying to set up a print-on-demand store for extra income. And then the property, I've put the property on the market and things are but stagnant on that side. And yeah, I've already put all my key learning points for this call.
No, I love the fact you're a top achiever. So that's brilliant in terms of your key learnings. They use furniture packs to improve rental income. The value of property lies in the income. I think that's probably should be the strongest message that everyone takes away. And then rental income increases in stable growth. But if you reduce or remove the unnecessary costs, it can assist the interest rates fluctuating and it can ride through the storm. You can make money. So, you know, what's so interesting, I try and teach this over and over again. It was that lesson I learned that capital growth is what middle class and professionals chase, and income is what professionals, you know, the top 1% chase, because ultimately it's what gives you the freedom, you know. And I think you heard Gary say that over and over and over again today, you know. Cool.
Thank you.
Garth, I think you were, and Abdul also said he's ready.
Yeah, sure. I'm happy to go. If you have to scroll down to August, just down there at the bottom there, Scott. But it's really simple. You know, in July I was away a lot. Unfortunately, that's a very busy time for us on the tours. So July was a write-off really. It was quite nice. I was away with my family. They joined me on the 3-week trip in the UK to 3 tournaments, and it was nice for them to be on the road with me. It was a working holiday in my sense, but you know, my family got to experience and enjoy the UK. My 2 sons have never been, so it was nice for us to show the UK to them, and they thoroughly enjoyed it. So it was an awesome time. Feel very privileged to have had it. Going forward, obviously, you know, it's nice to be home. I've been back now for a month, working hard back here at the academy. I've had a lot of my golfers back, so I've been able to do some really good, strong investment training work with them and getting vested back into their fitness. But now that they're all starting back on tours now, so I'm going to be back on the road from later this month. Obviously, really excited by the DWG deal and that it's all closed out, and looking forward to those first tasting the honey, as I think you said, Scott. Looking forward to that first.
Well, you know what's worse, Scott? I've got a worse way of saying it, but if I say cocaine and stuff, then people think that I'm a big user. So we'll stick with honey. I think honey's better. You know.
Fair enough. You know, obviously from my side, the challenge is, you know, I have been very busy here, and you know, on the backside of that workshop. Or webinar with Clem. My brother actually also tagged in on it. And, you know, when Clem mentioned that, you know, one of the biggest challenges that we have, particularly in developing countries, is actually finding ways to fund these entrepreneurs and startups. My brother pinged me and was like, hey, this is this company that, or product that they're trying to start. And it's called Main Street X. And maybe I wanted to chat with you, Scott, about it. But, you know, it's basically an online trading platform where, you know, the general pop can buy shares in a company and a startup. You know, so not your typical stock market where it's only those that have now listed. These are startup companies that are trying to look for assistance, almost like a crowdfunding type option. And you know, when Clem said that, it was like those two need to connect in my opinion, because I firmly believe that that's really what's holding a lot of the developing markets, the economy from really booming is investment into those type of companies. If we can build and grow those sort of that area of the economy, I think it can really sort of help bolster and really float the economy. So maybe we can have a chat about that going forward.
Certainly, Garth. I mean, just on that note, definitely let's reach out. I mean, I've basically been doing crowdfunding since 2013, and we started the African Crowdfunding Association in 2015. So yeah, I've learned a few mistakes of what not to do in crowdfunding, and obviously we've done 2 big raises with Cedars, which is the largest one in Europe as well.
Okay, perfect. Yeah, well, if I can put you in contact with my brother, and because it's his business, his products, it's not really my realm, but I think there's something there. You know, obviously for me, from top 3 questions is, you know, where's my next investment going to be? Obviously, I've done Joined up with Calio, which has been great. Obviously another DWG as well. So the next one is, where do we go? Do we go in that Australian co-share? You know, we had that US medical right back at the start. And then obviously now that this UK large scale residential is certainly, I think, very, very attractive, particularly like what Gary said, this is a long-term thing. You know, we have our short one where we're going to be getting, you know, our investments back on a monthly basis, but I know that I need to be putting money away for proper long-term growth, and just put it away and leave it. And I think maybe the UK residential seems like a very attractive opportunity and option. So that's why I really enjoyed today's session, because I felt like I learned a lot, and certainly made me realize that maybe this would be the way to go. But yeah, that's pretty much
Can I just answer that quickly? You know, when we diversify and we say countries, currencies, assets, partners, and time,
Yep.
you're also diversifying across time, because some investments are like a 1-year investment, some are 3 years, some, as Gary said, are 10 to 20 years. So what becomes important is you also want different assets with different time scales that have different maturities. Like it's important that, you know, that maybe everyone understands that already, but that's the idea of diversifying across time as well.
Absolutely. So like that, and I think that's been great. I've got to figure out exactly what would be my next move. And I think, you know, I think we're all in the same boat. You know, we've made the move into whether it's structured notes or whatever. I know, you know, Hannah's been in that. So, you know, it's like, what's next for us? And I know if we've got some equity or capital that we want to invest, then it's like thinking, okay, well, what have I got in my portfolio? And, you know, for example, time. I've got these 2 of time, and I need to invest in something more long-term or whatever. So it's quite exciting by that time. I really feel like I'm learning so much more about investing. And obviously through the Going Global course, it really has opened my mind to the different options that you have available to you in a diversified portfolio. So thank you so much. Obviously, the whole point of this mastermind was to gain that level of education first and foremost, but also to be guided and be assisted in actually joining with the partners that are necessary to make this thing come to fruition. So yeah, always thank you so much, Scott. Really appreciate you and Alex and everyone else on this platform, because it's been amazing.
No, thanks, Father. Now, look, we do have a challenge as investors coming up, and I'm telling you, we've got a challenge because we've got DWG with a new deal. I don't know what it is, so I've got no idea. We've got Bruce Saunders, who has got hold of me to say there's another medical opportunity coming up. We've obviously got Gary that has, you know, I've managed to whet his appetite to let us participate in his deals. Nathan signed the deal on the co-living about 10 days ago. So I don't know yet, like I've asked him for the business plan, but I don't have it yet. And then obviously Garth got hold of us yesterday, so there's 2 new deals. So, you know, in the near future, we could be choosing between 5 or 6 deals as investors to be able to participate in.
Well, that's exciting for sure. So thank you.
Cool. Abdul, you mentioned you were ready.
Yeah, thanks, Scott. Okay, I don't know whether my worksheet is up there. Okay, but obviously my progress hasn't been as wonderful as everybody else's, but at least I got some progress. And the progress clearly was what keeps me back. And I told you it is my involvement in my practice. I've been working on that, and I've actually identified a person to take over my position. However, that's only going to happen in 6 months instead of this year in. But I think it's progress, and that obviously would free me up to do other things. Thanks to Alex, okay, we managed to get engaged or partake in the DWG deal. That's signed and sealed. And then thanks to Alex again, who introduced me to Siska, who then got me accredited on board, and we now actually have a wallet with Lemon Way. So I think there is some progress. And then in terms of the other things, obviously I'm a fairly busy person, and obviously, you know, the type of time frames I put to things may not always happen within those time frames, but I'm working at it.
Well, I think, Abdul, just to celebrate your progress, I mean, you know, we only met each other properly not even 2 months ago, and you know, you've met with Alex face to face, you've invested in a deal, you've KYC'd, so you know, you made tremendous progress. I just want to acknowledge the progress you made. So well done, you know, and yeah, it's exciting. I love to see people that, you know, want to commit to the mastermind and want to, you know, ultimately move forward. And, you know, ultimately we had to invest and earn passive income. That's what it's about. So well done on moving through those steps quickly. And again, I do, you know, I have mentioned already today, but, you know, Alex and I are trying to work like a team. Abdul and Alex met face-to-face in Cape Town. You know, if we can do face-to-face, we will. But if not, there's Zoom, you know, as well, you know.
Good. And it's highly appreciated. And I obviously thank Alex for the time that he's put aside to come and pay me a visit on my premises.
Yeah, and I still owe you.
It's only.
I owe you and Ross both a visit. I promised both of you a visit when I'm in Cape Town.
Yeah, we look forward.
Well, Abdul, it was only a pleasure. I've now met 2 of our mastermind individuals in person. So I hope that over the next couple of months to meet everyone in person, actually connect and build a long-term relationship, because as Scott's always said, this is but the start of a long journey. So it was a pleasure seeing your house and connecting, and looking forward to connecting with everyone else.
Thank you.
Perfect. Thanks. Well done, Abdul. Anyone else? I know some of you are brand new, so you don't have to jump in terms of the process. Obviously, the idea is we're wanting to move you and everyone, help you move the needle forward in terms of every month. And like I said to you, what I'm going to do, 2 things, just to let you know, is I'm going to make myself available at an hour before the session, an hour after the session, and then an hour in the evening from next month. There's no point in doing it today because otherwise people wouldn't turn up. But really wanting to try and encourage everyone to take 3, 4, 5 minutes to update the progress. And again, I repeat why. When I was part of Roger Hamilton's mastermind, Roger does it slightly different to me, because I'm asking you to volunteer and say, hey, do you want to do it? Roger doesn't do that. He goes, Scott, tell me what's on your sheet. And I am considering going to that. I'm not going to lie, because then if any of you have been at school or university, none of you like it when the teacher asks you about your homework. So it's a bit like self-accountability. And I would every month, the night before, I'd go through like, shit, what did I say I'd do for the month? Am I on progress? Am I not on progress? And quite often I might only do the task I said I would do for the whole month, the night before the presentation. But it meant that I was moving forward monthly. And that's my real request to everyone, is that, you know, we're part of a group, we've invested our time and our money, and I really want to help you get measurable progress. So I don't want to be the guy beating a stick too much, but I do want to help us make measurable progress. So I'm just you know, letting you know. So from next month, I'm really going to look at a way where we can get more accountability and you know, I notice a number of people aren't filling in the sheet, etc. We are gonna look at ways to adapt that, because I know it's good for everybody to make measurable progress. Does that make sense? Yeah. And then the other thing, just to remind you, which is it's an offer that I you know, share with everyone. Sorry, I just want to share my screen again. Is what's called a hot seat. And you know, again, my invitation to you with the hot seat is so I've actually just, something we're going to play with next week. But what I was thinking is that if people can't, you know, there's a great tool that I learned in business, where if you've got team members, you actually get hold of them, and, you know, they get back to you either at the end of the day or end of the week, and they just update you on like what their top 3 things were. And what I was thinking is, if people don't have the time to actually turn up, they could still, you know, either update the sheet and or send me a voice note. So I'm really, you know, wanting to kind of emphasize, we're really going to figure out how we can move step 4 forward so that everyone, you know, is really getting that measurable progress. So that was what I was talking about there. And then just to remind you on the hot seat, you know, again, the idea behind a hot seat is you can kind of sit there and you can have all the problems on your own shoulders, or you can sit with me, you just get hold of me, as I said, we've now got 3 hours in this day. It's plenty of time. You say, hey, Scott, I'm trying to figure this problem, and I'll use coaching techniques to kind of help you think through the problem and to come up with ideas, and possibly other people even get to participate, etc. So it's a resource. Use it, don't use it. I'm available if people want to, do that. So please just let me know if you're wanting to do a hot seat, and ideally even a day before, if you get hold of me and say, hey, Scott, I want to do a hot seat on this. It's great because A, I can think about it, and B, I can plan for it. Does that make sense? So please, I keep mentioning it. It's here. Don't say I don't offer it. But I can't give you a hot seat unless people actually ask. And then finally, just a reminder, the Google Sheet, it looks really simple, but it's an incredibly valuable tool. So a strong recommendation, to try and to fill it in. And if you need help from myself or Alex, let us know. So Justin, just quickly, perfect, asking questions, no problem. Alex, what do you do?
Good question, Scott. What do I do? Well, anything from speaking to our investors, to our shareholders in the company, to making sure people understand how the platform works, get onboarded. Effectively, the human hand, or what did we say, Scott? We're a digital company with a human heart.
Yeah.
So effectively,
with a human heart, yeah.
There we go. So if there's any questions regarding anything we've discussed, and also I see myself going into a little bit of a different role. That's what we're going to discuss next week, as well as keeping people accountable. So basically pinging you, phoning you, bugging you, have you done this? You said you did this, and so on and so forth. So yeah, it is, I wear many different hats, but ultimately just getting our clients results. That's effectively it.
And I think just to add to that, Alex and I have known each other for a long time. Alex joined the team in 2019, and we've worked very closely together. So at a mastermind level, there's no specific role that Alex does that I don't do, and vice versa. We work very closely as a team. And it's really sort of, again, reminding you that at a mastermind level, the way we like to see it in our head is it's private banking, or it's first class, whatever you want to call it. And it's a bit like if you're used to a private banker experience, you don't quite know the banker is there to help. Like there's not one prescriptive thing they do. But Alex knows our business inside out. So if he doesn't know the answer, he knows how to get the answer, is the right way to describe it. So back to your thing, Justin, between Alex and myself, sometimes I'm not available. Alex and myself work together to really help you get results. And I love the way you said it there, Alex. Help you get results no matter what it takes, whether it's the stick, the carrot, or advice, we'll determine. but ultimately, it's about getting you results. Have I lost you guys? No. Does that help, Justin? Cool. Awesome. And just to remind you, actually, I will share my screen again quickly. Alex, maybe if you could just put it looks like we've lost him quickly. I'll put his contact details in the chat box as well, but I'll also just put them on the screen quickly. Here we are. So here's Alex's details here. Let me see if I can copy these. I'll just put them in the chat box as well. Where's it gone now? I'll put it in the chat box, but yeah. And maybe what we'll do is we'll just put it on the WhatsApp group as well for everyone. So that helps. Let me put it in the chat box. Cool. Okay. So I don't know if there's anything else from anyone. Any other questions there? Alex has put his number in. Oh, Alex, I've got the wrong number for you. You've obviously, oh, sorry, I've got your other number, not your work number. Okay, we need to update that slide, just by the way. But yeah, Alex has put in his number. Let me update that number right now.
Yeah, so it's the 06628288743 number, but I'll just share on the group again so that everyone has it.
8288743. Cool. Okay, great. Just so I've got it, and then I'll put the links in as well. So, ladies and gentlemen, if there's no other questions or anything else we can help with, please, as always, Alex and I are available on WhatsApp. Reach out to us. We're both on the group. If there's anything we can help with. I'm glad you enjoyed today's session. I certainly did. And if there's anything we can do to help, as I said, Alex and I, there's a bunch of you that need to move through step 2 and step 3 in terms of your current portfolio, Calio, etc. So individually, we're going to be, really pushing that, and trying to get people going. I think the final thing I would say, which is quite scary, is that I was thinking about it. And if you consider that, pretty much most of us shut down around the 15th of December, going into a Christmas holiday, means we've got 4 months left. And when I had that realization, I was like, where did 2023 go? And it's bloody scary, actually. So yeah, it's just a thought. My philosophy is we've got 4 months left. Let's make sure we finish this year strong. Well done to all of you that have participated, to many of you that are on holiday and let me know. That's perfect. I hope you enjoyed the recording. And most importantly, let us know how we can help you get results. So thanks for everyone's time. And yeah, Diana, I'm going to stay on with you and Alex to go through the calculator. Diana's very kindly building us a sophisticated calculator to look at property portfolios. So I look forward to sharing it with everyone. Awesome. Thanks, everyone. Have a wonderful day. Cheers.
So Scott, just to confirm, you